Ladies and gentlemen, dear colleagues, welcome to Vienna, welcome to the Austrian Central Bank. My name is Martin Summer. I am part of the local organizing team and I'm responsible for research at the OeNB. And I'm very proud and honored that I can open today the 13th Economics of Payments conference. And you can imagine that such an event, and some of you know it is a big collaborative endeavor. So I would like to start first by saying a few words about the program. We had close to 90 submissions, and then we faced the difficult task to make a choice, a very limited choice that can fit in these 2 days from these submissions. And this was only possible by the help of a really great program committee. And let me take the opportunity to thank the members of the program committee first who helped us to put together this excellent program. So this was from the Bank of International Settlements, BIS, Morten Beck and Tara Rice. From the Bank of Canada, our old friend and collaborator Kim Hyun. From the Bank of Finland, Matti Hellqvist. From the Bank of Japan, Nao Sudo. European Central Bank, Simonetta Rosati. Federal Reserve System, Francesca Caprella, Fumiko Hayashi, Oshai, and Joanna Stavins. Thomas Nelland from the Swiss National Bank. And last but not least, Helmut Stix and Helmut Elsinger, my dear friends who put so much effort into making this a great event and everything functioning very well. I would also like to especially thank the president of the Economics of Payments Steering Committee, Fumiko Hayashi and Kim Hyun, who helped us to set up a very interesting program and to settle organizational issues. Without their help, we couldn't have done this. Thanks so much, Fumiko. Thanks, Kim. Now, today is a special day because this is a sort of a joint day with a conference that was taking place previously here, Advances in Financial Technology, organized by Rainer Böhme, Bernhard Haselhofer, and Luciana Kiffer, which is a technology conference that is related to the subject we are discussing here. And I should say that we, at the research of the Austrian Central Bank, have the extreme privilege that we have two outstanding, excellent colleagues in the university landscape of Austria, Rainer Böhme and Bernhard Haselhofer, who are also our research partners. And through this partnership, we learned that Bernhard and Rainer would be the hosts of AFD, and this is how the idea came about, to team up, to collocate, and to organize the event in a way that we hope builds a bridge between these two communities and help the two crowds get to know each other and interchange, because it is my personal experience from being involved in mainly CBDC discussions that we, the central banking community or the economics of payments community, if you will, really need this exchange. It's impossible for us to build the necessary knowledge in this short time. I'm sure over time this collaboration will also have a structural effect on the composition of central bank staff if these projects go forward. So I'm very happy that we can set here a pioneering step, and great thanks to Rainer, Bernhard and Luciana for being so open to do this with us. Now, I'm almost done, but it is still important to say a few organizational things, not very much. We have now a program in this afternoon that has keynote addresses, that has paper presentations, a panel session. I should say each paper gets 40 minutes. In total, this means 20 minutes for the presenter, 13 minutes for the discussion, and 7 minutes for the Q&A. And we have program chairs who will monitor and enforce this time allocation. We will record the whole event and eventually we'll publish all or parts of the conference on YouTube. Should there be anybody in the audience who does not want his contribution to be broadcasted on YouTube, please just get in touch with Susanne and Karina and Helmut in the back and just let them know. It's no problem for us. Now, this evening, in the spirit of the overlap day, we will have a reception where posters from both the AFD and the Economics of Payments will be presented. And we hope that many of you from both communities join us. And it's also, I think, a great event and a great chance to meet people from all over and get in touch and have some food and exchange on this interesting work. The poster session starts at 18:30 and takes place here at the very spot, so you don't have to change buildings or travel. As a member of the audience in the EFD, I noticed a very tiny detail that I think is worth mentioning here with the organizational things. It is a well-known fact that human height is following a normal distribution. This means there can be quite some substantial differences, and for your audibility in the room, it is important that the mic is at the right position. And in order to ensure that, we have advances in presentation technology, because this super cool desk has an up and down button which you can operate as a speaker. So if you're small, push down. If you're large, push up and make use of it. And Fumiko will now introduce our first keynote speaker, Charles Kahn. Fumiko, please.
Thank you, Martin. I may need to push down this button before I start. Oh, this is so cool. Good afternoon, everybody. I'm Fumiko Hayashi. I'm really honored to introduce Professor Emeritus Charles Kahn today. We are very pleased to have Charlie as a keynote speaker at our Economics of Payments XIII conference here in Vienna. He is a Professor Emeritus of Finance and Economics at the University of Illinois, Urbana-Champaign. His contribution to this Economics of Payments conference series are among the longest. At the first conference held by the Federal Reserve Bank of Atlanta in 2004, which was 20 years ago, Charlie served as a discussant for a session on monetary policy and theory and payment system. He came back to the second conference at the New York Fed in 2006 to give an invited lecture. Charlie or his co-author presented their papers at the past conferences as well. So many of you may know Charlie already through this conference series or other payments or finance conferences. Those who are central bank researchers may have interacted with Charlie at your institution, as he has been serving as a business scholar, consultant, or seminar speaker at many central banks. Those institutions include Bank of Canada, most, if not all, of Federal Reserve Banks, European central banks, IMF, the Central Bank of Colombia, Bank of Ghana, Bank of Japan, Bank of England. I cannot name them all, but so many central banks. Those who are new to this field may have read Charlie's paper, as he has numerous publications, many of which are from top journals and for book chapters. So Charlie's research covers broad topics of finance and economics, providing deep analysis and insight. In terms of payments, his research covers both wholesale, large value payments and retail, small value payments. Topics include various risks, such as credit risks, liquidity risks, counterparty risks, systemic risks, as well as payment safety, security, and privacy issues. His recent research focuses more on new technologies and new payment methods, such as decentralized finance, DeFi, distributed ledger technology, blockchains, cryptography, cryptocurrencies, stable coins, CBDC, which is central bank digital currencies, tokenized deposit, programmable payments, and so on and so forth. Charlie's remarks today are around his recent research. New payment methods based on new technologies such as cryptocurrencies and stable coins have been gained traction as investment tools, but they are not widely used or adopted as for transaction purposes. Many jurisdictions experiment and research CBDC. Last night's conversation around CBDC was really fascinating, but only a few have implemented CBDC, and even those countries, consumers, merchant adoption seems to be really low, especially for retail use of CBDC. So how likely new payment methods will be widely adopted and used for payment purposes? Do new payment methods or a mix of new and existing methods better serve in the digital age? What changes, if any, may increase adoption and usage of new payment methods? What is the right balance across many desirable features or outcomes such as privacy, resiliency, security, efficiency, ease of use, better customer experience? I think Charlie's remarks today may address some of these questions and inspire us, researchers, to do more research. With that, Charlie, the floor is yours.
Thank you, Fumiko. And thank you to the organizers for inviting me to be here. It's been a very exciting few days already. This idea of putting the two conferences together has been a marvelous one, and my attendance in the last couple of days has been eye-opening for me to see all the work, interesting work that's going on through the AFT group. And I suspect that I will be a little more familiar with the work that's going to come up in the next couple of days, but I'm also pretty sure it's going to be no less interesting. And so I thank you for the opportunity to be here. So, although you cut back on some activities as you get older, but you do a couple of things more often. One of those is giving keynote addresses. Another of them is ranting about how things used to be better in the good old days before current technological advances, or supposed technological advances. Today, I'm going to do both. A few weeks ago, I tried updating my registration at a website for a financial firm I do business at, and I tried, and repeatedly failed. The problem was that the site had a couple of my different emails in incompatible locations on the site, and they were incompatible with the rest of the information on me, and so that couldn't get into the site in the first place, and so there was no way to update anything at all. And with the reduction of availability of human assistance, the site had hidden all of the phone lines and left only an automated help arrangement whose FAQs and information sets didn't cover the problem. Now, I get it. Automation is great. It makes 95% of the interactions between customers and businesses more efficient. But it doesn't handle exceptions so well. Exceptional handlers are themselves automated, and the automated exception handlers are more difficult to navigate. And this is inevitable. When I get into a telephone tree, if it's not immediately clear which of the alternatives applies to me, my instant instinct is to push 9 to get the assistance. And that is, of course, the immediate instinct of everybody older than Generation Z. Therefore, companies in self-defense have to impose costs on doing this. And that cost takes the form of a wait for the next available operator. Were it painless to get an operator, no one would use the tree. And even if it is costly to avoid the tree, there's still the temptation to bypass the tree because, after all, there's an escape key, you might get hope of special treatment, more merciful responses from the human than from the cold logic of the computer. You see, most problems of an organization do have standard solutions. And so a rational presentation of those standard solutions, whether telephone trees or FAQs, makes things easier for the company. And it arguably makes things not just simpler, but more fair and certainly more predictable for the individual himself. What we're observing here is bureaucratization. Now, that's the intellectual territory of the celebrated sociologist Max Weber. And as he observed, bureaucracy, whether governmental or business, while it rationalizes processes, creates its own set of problems. By centralizing and by standardizing, you get rid of the discretion at the lower levels, and you concentrate the power and the discretion in forms of exception handling further up the hierarchy. Okay, what does all this have to do with the current state of fintech and payment systems in the financial industry? The most pressing questions in the economics of payments and fintech at the moment are questions of industrial organization. What's going to be the market structure that arises from all of the innovation we're seeing right now? So cheerleaders for the innovations love to predict this is going to be a wholesale revolution. Dinosaur institutions are going to be replaced by upstarts with new and better ways of doing business. Just as in the other branches of technology, the organizations that are going to be dominating in 5 or 10 years wouldn't have been around 15 years ago. On the other side, of course, are the Luddites, who argue that for all of the ballyhoo, the most innovative of financial technologies are solutions in search of problems, and most people will never find them more than a curiosity. Like stamp collecting, or curling, or Dungeons and Dragons, most of us will be aware of them, but they will end up as niche presences of serious interest to a limited set of enthusiasts. Previous experience of technological adoptions by financial service industries actually predicts that neither of those are the future. Instead, the existing firms are going to be, as they have been in the past, very adept at co-option. Here's a cover from Time magazine of an article predicting the demise of banks in the face of technological developments in payments. Are banks really necessary? It asks. And that's a really good question. But as you see, it was being asked back in 1998, and the banks are still around. Credit cards also have a track record of surviving technological change. Bank AmeriCard, which was the predecessor of Visa, started in 1958 as a service of the California-based Bank of America, and the original implementations were strictly analog. For those of you too young to remember, and I guess that includes basically everybody in the room now, the original plastic cards were actually embossed. You had your name and the credit card number raised from the rest of the card. And the clerks would be using a mechanical device that was not so affectionately known as a knuckle buster to record the transactions. Fraud? Well, fraud was handled in the following way. The credit card company would, every few weeks, issue a new pamphlet listing all of the stolen cards, all of the fraudulent cards. And if you were a clerk, you would, at every transaction, go refer to this little list and check it to see whether it matched. And you did that in the hopes that you'd find one, because if you got one, you got a bounty from the credit card company for returning it to them. So the technology has come a long way. Indeed, both banks and credit card companies have long histories of adopting apparently revolutionary payments technologies, although sometimes the hype does exceed the substance. For instance, Here's a report from Booz and Company in 1997 about the rapid adoption of internet technologies by credit card companies. Nearly all of the credit card issuers have a presence on the internet, it announced. But if you look closely at the thing, what they were saying was that most of them, well, half of them, what their internet presence was a phone number that you could call if you wanted to go ahead and apply for a credit card. So sometimes the hype is not as great as the hype is greater than the actual performance. Still, eventually they do get there. Currently, there are any number of technology companies out there eager to help financial institutions adopt new payments and technologies. And this is an example of a Finnish firm that provides systems intended to enable credit cards to meet challenges from alternatives such as digital wallets or WeChat and Alipay. And again, the offerings are less revolutionary than they seem. They're actually simply reworkings of the existing ledger systems to make them more quickly able to incorporate the new functionalities as they arise. So, maybe these aren't such radical improvements after all, but the prediction I would want to make is that even for the more radical changes observable in the current flurry of innovations, the process is going to be ending up much the same. The technologies are adopted by existing financial giants, incorporated into their existing structures, and the institutions proceed with a new set of tools, but without that much fundamental change to the operations. Because despite the heady valuations of cryptocurrencies and despite all of the investments into independent startups, these institutions are still largely outside of the mainstream of financial interactions. If you're not a crypto enthusiast or a money launderer, or to be fair, if you're not an inhabitant of a country where money and payments are dysfunctional, then there's not going to be much interest in this stuff. The technology may be revolutionary, but as far as the financial impact is concerned, on the public, the revolution hasn't yet arrived. Now, don't get me wrong. There's nothing wrong with being the provider of back-office services of technologies to banks. If you look at the website of my local bank, you'll find that its e-banking services, like those of most community banks in the United States, are in fact provided by a company called Profit Stars, which is a subsidiary of the Jack Henry Company, which is a major payment service provider, and like the Finnish example, Tieto Evry, a technology advisor and a large and very profitable business. Nonetheless, becoming a back-office service of an existing institution is probably not what the biggest visionaries had in mind. So, why am I making this, this prediction that co-option is going to be the future? Actually, it comes back to the advantages of a bureaucracy. Think about it. What does it take for a revolutionary system to become mainstream? It takes a couple of things. The easier one that it takes is to make the system more user-friendly. Now, computer types, you guys have lots of experience in expanding the usability of new products to wider and wider audiences by simplifying the interfaces. Just as automobiles became less needful of mechanical sophistication to drive them, programs become more and more nearly idiot-proof. And while these exceptions inevitably leave the earlier adoptions seething because they're hiding those arcane but much-loved buttons out there, they usually are such as to make the average user finding things more acceptable. But that's the easy part. The hard part is to integrate the systems into the mainstream. Just as the bottlenecks arise in electrical vehicle adoption when you try to figure out how to get those things back to having batteries that are going to charge up at wherever you're going to want to be, the problem is going to be that trying to figure out how to integrate into the mainstream systems. Now, why is that so difficult? Several reasons. In the case of financial institutions, part of the difficulty is due to the unwillingness of the existing financial institutions, the incumbents, to play nicely with the newcomers. Financial systems include lots of networks, and network externalities are a big advantage. Why should incumbents be interested in letting upstarts join their networks? Why should a bank be interested in letting a payment service provider have easy access to the valuable customer information included in all of those accounts? So, if it's the case that the technology is going to be cost-saving and pose no threat to the incumbent's market power, you can expect the bank to act quickly. Adoption of AI techniques makes customer service arrangements even cheaper, poses no threat, and financial institutions have happily jumped in even when the experience is marginally worse for us poor customers. On the other hand, if the financial institutions like Deutsche Bank are happy to announce that participation in long-run projects with agencies like Singapore Monetary Authority, piloting revolutionary arrangements, just don't expect anything to happen from those things anytime soon. Second reason, even when innovation provides benefits both to the consumers and to the institutions, adoption can be slow because of first-mover disadvantages. In the US, the adoption of chip and PIN has, without question, reduced credit card fraud significantly. But adoption lagged behind because of the chicken and egg problem. Why should the banks issue chip and PIN cards when merchants lack the appropriate technology? And why should the merchants get the appropriate technology when nobody was using those cards yet? In Brazil, regulators forced all of the banks to join the instant payment system, PIX. Coercion was felt to be necessary to get the system up and running, even though its success has ended up yielding profits, after all, to those banks that were forced into it in the first place. So, one of the roles of a government is to break open the incumbent club and coordinate the adoption of technologies. Notable examples of that or notable attempts at least of that, are the ECB's PSD2 legislation, carving out a role for new institutions. So those are two considerations, but there's a third and extremely important consideration as well as to why adoption ends up being slow. Because there's a misunderstanding by upstart institutions of how and why to play nicely with governments and legal structures. Part of that's ideological. There's a strain of radical libertarianism in the developers of alternate financial arrangements, a desire to maintain independence from the existing corrupt regimes. But a large part of it, I think, is a misunderstanding about the needs and uses of escape keys. Let me explain that by an analogy to contracts. Early in my career, I decided to sit in on a course on contract law. As a theoretical economist and working on incentives and information, I figured I knew what a contract was. A contract's a mathematical function from the state space into the set of actions by agents. That's at least how mathematical economists modeled them. Now, this supposed insight was not to go over well with the law professor. Because contract law, in fact, focuses largely on the edges of what economists think of as contracts, on what happens when the states have been omitted from the agreement, or what happens when there's a disagreement about the interpretation of the function. In other words, the law focuses on the escape keys. Existing financial institutions also put an extraordinary amount of effort into these questions, and they do it in two ways. First, they do it by describing in excruciating detail, as part of their arrangements, the sequence of actions to be taken in exceptional circumstances. Secondly, they do it by specifying governance structures to be used when the tree of alternatives runs out and discretion must be employed to fill the gaps. In other words, they establish a bureaucracy. An interesting example of that is the clearinghouse. A clearinghouse is an institution that's an essential part of financial infrastructure. It provides the services that lead up to the settlement of a transaction. And for concreteness, I'll focus on derivatives markets and their clearinghouses, like the Chicago Mercantile Exchange. In principle, the clearinghouse's function is fairly simple. Once trades have occurred, the trader's positions are recalculated, margin requirements need reassessing, margins need collecting as collateral and position values change. These tasks are highly automated and ripe for innovations, making them ever more precise and rapid. It would seem like the dinosaurs with legacy technologies and ways of doing business would be at a distinct disadvantage against upstarts. But the dinosaur also has some important advantages. The most important of them is a deep, long-standing rule book about the exceptions and how they should be handled. Here's a table of the contents of Chapter 8 of the Merck's Rule Book, which is the chapter dealing with clearinghouses. And what should happen if something goes wrong? Who owes what in case of a default? Which funds come from which sources are applied and in which order? What to do when mistakes are found on the records? What counts as proper margins and what counts as offsets? Just as important in the longer term is the governance, which explains what to do when the rulebook runs out or when unanticipated arrangements arise. Indeed, the success or failure of futures exchanges during crises depends greatly on whether these structures were put together sensibly and whether decisions that are made in a crisis are effective. In a crisis, judgment calls have to be made. Is this the time to suspend the rules? And if so, how exactly? Allow for greater time to meet the margin? Shut trading temporarily? Reprice the underlying contracts in some way? And who gets to decide? While failures of central counterparties are extremely rare, they do occur. And in examples that Virginia France and I have been looking at, notably Paris in the sugar markets in 1974 and Hong Kong futures exchanges of 1987, the failures stem from decisions that were viewed as arbitrarily favoring one set of traders over another set in an emergency, leading to the disfavored group's unwillingness to continue to participate when the crisis abated. If the rules are good, then the institution is more likely to survive successive crises. And so we want to make the incentives right to make this possible. We want governance by entities that have a stake in the success of the institution itself. In the traditional case of futures markets in the US, that role was taken on by the owners of seats on the exchange. In the corporate world, that role is taken on generally by the shareholders, delegated in turn to the boards of directors. Cryptocurrencies are intended as a new environment. Brownworth and his co-authors, in a generally insightful posting on the New York Fed website, argue that there are two factors that make the crypto environment different, and those two factors are open access, anyone can play a role, plus incentives for good behavior. And now I would argue that, in fact, those aren't clear distinctions from the traditional structure. In fact, crypto structures are, if anything, beginning to duplicate traditional structures. In the crypto world, the governance role is taken on by owners, taken on increasingly commonly by owners of DAO tokens in analogy to traditional shareholders. Ownership of the coins provides voting power on governance issues, and the value of the coins depends on the value placed on the institution. And it's become important. Total market cap of the various DAO coins is currently over $21 billion. Now, the situation in fintech exchanges is not quite analogous to that of futures markets in one important respect. The futures markets do not directly deal with the public. CME, like other trading institutions, deals directly with its members only, and that's a limited group, who in turn deal with the public, though customer service is delegated in a hierarchical fashion. The philosophy of a decentralized exchange is to eliminate hierarchies, to have the customers deal with one another directly. This philosophy is not strictly carried out in practice, as middlemen jump in to provide intermediation. Still, as an ideal, it has an effect. It forces a limitation on the complexity of the real book relative to established exchanges. After all, these poor upstarts don't yet have the market power to impose complex rules. Customers will simply walk away. And in analogy to the cases for traditional derivatives markets, the success of the arrangement depends on a careful balancing between governors and users. What happens when ownership of a futures exchange seats are concentrated among a particular class of traders? It can be disastrous if you get the mix wrong. For example, domestic traders versus foreign traders have different interests, and it can cause a problem in a crisis. What deters the conflicts of interest, on the other hand, when a few particular holders of cryptocurrencies obtain a 51% share in the Dow, as Jan's talk earlier today was examining? In emergencies, how are these changes arranged? For example, the smart contracts underlying a coin may convey blacklisting powers, locking addresses that contain stolen value. The coin locks in compliance with the court order. Some libertarian-minded supporters are appalled by this, quote right there, central government and control and censorship is just going to get worse, and USDC stands for censorable. Nonetheless, this ability has become increasingly important over time. So while designers of smart contracts envisage arrangements in which every alternative is automatically incorporated into the text, the history makes it clear that this goal is a mirage. This is a graph from Dune.com showing the increase in Tether's banning of addresses over time. Tether has an override in which a key individual can block the coins. And as I understand it, and you can correct me if I'm wrong, this facility originated when an employee stole some Tether coins. And I believe the feature was added by modifying Tether's master contract. But these modifications in turn lead further into governance questions. Who gets to decide the circumstances in which the blocking will occur, or the rules themselves will be overridden or modified, and how quickly and under what circumstances? In any event, pursuing this stream is not the way to widespread usage. Customers will want simplicity and the ability to deal with exceptions, unexpected events, fraud. And while some will not worry on a day-to-day basis about systemic breakdowns, the government regulators will certainly will. Is the system FDIC insured like Zelle, where funds never leave the bank? Or are accounts held through a non-banking institution like Venmo? Younger customers may be happy to give up the FDIC protection in return for the reduced clunkiness. But as the system becomes more systemically important, regulators are going to be unwilling to leave it outside of the protective ring. So, as the systems mature, the idea of independence from the existing structures becomes clearly a myth. Because in well-functioning legal systems, the most robust set of procedures and precedents are actually embodied in the established rules and regulations. And so instead of reinventing the wheel, the systems eventually plug into those structures as they become more complex. Meanwhile, the legal structures themselves adapt and expand their rules to cover the new situations. For example, the UK adapts its bankruptcy rules to cover digital assets. Okay. How do these considerations apply in particular with respect to privacy? Well, the truth is they get really complicated. The problem is we're ambivalent about privacy. We're all in favor of other people having privacy except when they're doing bad things. So I want the government to find out what people are doing in some cases, but how do I limit it to those cases that I agree with? Now, personally, I would never do bad things. If I do illegal things, I'm only doing illegal things that really shouldn't have been illegal in the first place. And so I'm in favor of complete privacy for myself. I want the sites to protect me against people finding out about the payments I made, except, of course, when I don't. As a practical example, I want finality in the payment system. Once the transaction is done, I want not to have to deal with that counterparty again. I don't want him trying to claim that the payment was inadequate in some way or pestering me for repeat sales or upgrades I'm uninterested in, so I want privacy from him. And I don't want anybody selling my information to questionable third parties, so I also don't want the payments company to know about who has paid what, except when I make a mistake and I want the payments undone. And so the system has to make rules for when the privacy will or will not be breached, and rules for the rules. And as the rules get more complicated, the procedures must be put into place to enforcement, and judgment calls made at the end of the situation to decide ultimately what's going to happen. And so the contracts are, in effect, incomplete again. So we're back to the need for a legal system to provide escapes and defaults. But since we're also worried about government overreach, we need limits on the regulations as well. Ultimately, we need a division of responsibilities. We can't put our trust entirely in any payments infrastructure. We'll probably need some combination of payments providers with different standards of privacy protection, attuned to different ones of our privacy concerns. And I'm skeptical of the ability of a central bank to provide such privacy protections on its own, but I can see it as the natural watchdog over the privacy standards imposed on private systems. Overall, then, we're going to want a legal structure regulating this ecosystem while maintaining some distance from it. It's not going to be an easy balance to achieve. We have to expect there's going to be readjustment and fine-tuning over time. And I expect that we're going to go into some of those issues during the panel discussion later. So, what are the messages from all of this? For designers of payment systems, they're pretty clear. If you become widely accepted, you're going to need bureaucracy, regulatory compliance, and escape keys. Live with it. The messages for regulators are more complex. Obviously, regulations need to be tailored to new situations. Again, PSD2 in the EU has recognized the need for adjustment from what are the general bank regulations to specific regulations different for payment service providers. Cryptocurrencies provide a more ambiguous situation. The shallower structures, the lack of escape keys stemming from the automaticity, would imply tighter scrutiny for consumer protection, tighter scrutiny for financial stability. So regulators have to understand the governance structures, the off switches that can be used in emergencies. However, the ease of moving offshore, the ease of moving offshore limits the ability of domestic regulators to impose sanctions. And as others observers have noted, it's going to be important to induce trade associations of these organizations to engage in partial self-regulation. So, while the jury is still out on the long-run relevance of cryptocurrencies, decentralized exchanges, and the rest of the fintech juggernaut, the technology is still changing rapidly, and central banks will need to be putting resources into understanding these developments and being ready to respond. And in case you're interested, meanwhile, I still haven't gotten my account straightened out either. Thank you.
Thank you very much. Do you have time for Q&A?
Oh, okay.
So, yeah.
Or we'll also be having a discussion on privacy. So privacy stuff you may want to delay.
So the next session talk about those issues, but we still have time to do Q&A. If you, anyone have any questions?
I'm going to sit here.
Shall I go if I've got a mic? Great talk and great work over the many years. Thanks very much. Rhys Bitter, King's College, London.
Thank you. Okay.
No worries, no worries. I was just going to ask what you thought the role of certain institutions like, say, the BAS should be in bringing these rather immature but exciting new technologies to bear might be. I look at a lot of the projects they do, Project Cucumber, Project whatever, so they've got a lot of names. They seem to be
very poetic names too, yeah.
Yeah, they're very poetic, very impressive. They're very, very connected almost always to the traditional banking rails. You've got Project Pixtrail maybe, which is about monitoring stable coins. But I sort of feel there's not enough attempt to reach out, and these are pilots, right, to reach out to these new maybe stable coins and so forth. Is it because Shin doesn't like stable coins and wants tokenized deposits, or do you think there's a role for these policymakers to bring in not just the banks?
So I think it is fair that you've got these institutions doing these pilot projects, because the parts that they are particularly concerned about are how to keep the interconnections with the existing stuff. Later on, you're going to have links back with the revolutionaries as well, but you need to have the expertise be built up for the central bankers to understand at least partially what's going on and how it would be in the short run, relatively short run, affecting the systems that they deal with. So I don't think that it's a mistake to be running those things on a separate rail line from the activities of the startups. I think what's going to have to happen is that they both grow up. They have to start meeting somewhere later on. We may not be there yet, though.
Well, I'm Wilco Bolt from the Central Bank of Amsterdam. I'm not a privacy expert, but I feel it's very important, and especially in payments. And with cash, you often people talk about anonymity, and with electronic payments, you talk about privacy. And I'm just sort of, is privacy a subset of anonymity, or does anonymity have different sort of implications than keeping information private?
I just had a really interesting discussion over lunch. Where are you? There you go. Okay. About trying to distinguish between the importance of anonymity of the user and privacy of the transaction. That in fact they're both important, and they actually serve different uses out there. So it's going to be a real mess to get a good typology of all those pieces. Although I'm sure that the computer science guys have done it more than I have.
Any other questions?
Thank you very much. Well, there's one. Oh shoot.
Thank you.
Jamie's going to stick me here anyway. Okay.
Thank you for your talk, Charlie. This is Jamie McAndrews from the Wharton Financial Institution Center. Your overall hypothesis that co-option will be the future that we'll experience with a lot of payment innovations raises a question today with the Department of Justice suing Visa on taking anti-competitive actions in opposition to the law to establish a monopoly in debit card payments. So incumbents around the world in many countries find themselves with a lot of market power.
Right.
And another potential role for regulators is to somehow establish
the boundaries of that market power.
Boundaries of that market power. So I just thought I'd ask you to comment on that for a second.
No,
Thank you very
that's
much.
I didn't emphasize it because I wanted to talk about the limitations, what I thought the blockages were right now. But again, the PSD2 example is just such a great example for saying, look, here's a place where we think there is a market power that has to be controlled. And yes, that's going to be clearly a job for a regulator in these areas. That the network externalities make market share just too powerful a force.
Franz Seitz, Weiden University, Germany. Charles, thank you very much for the interesting lecture on privacy. And what you did is essentially what every other speaker on privacy also does. He emphasized that it's very important.
Yes.
Yeah. Whether you call it privacy, anonymity, data protection, it's very important. So I think we all agree on that. But when it comes to concrete figures, how important is it to people? Give concrete figures. Any idea on that?
I think we're going to have a talk. Empirically, no, because I know that whenever I look at data on this, I get, yes, it's very important. No, it isn't very. It's very important, but I don't want to pay for it. Is always the answer that comes out. And I think there's a talk. Is it later on today? We're going to have some more information about that as well. And that is a part of the problem as well. Nice paper by Martin Van Orten and losing track who the co-author is on this paper. But looking at some of, what? Yeah, that's it. In Rodgate. That's on examples of why that paradox might exist, that in some cases I want the privacy for myself. There's an externality that comes from when the privacy is reduced, it actually damages other people as well. And so that becomes one possible explanation as to why this paradox seems to be out there of people saying it's important but not actually doing very much about it themselves. Thank you all very much.
I don't see the point of. We're now starting a panel where I ask you and your colleagues for the panelists to join me to take a sort of deep dive in some of the issues you raised.
The Americans outside.
The Americans outside. So, thank you. Good afternoon. This whole day is in the spirit of dialogue between different fields of expertise, and we're now gonna have a live experience of fostering and having this dialogue among different perspectives, uniting many eminent speakers which have a lot of experience in that cross-field dialogue. Two of the panelists have already been introduced. Neha Narula gave a keynote talk before lunch. She's a computer scientist who has spent a lot of time in applying her knowledge to the field of payments and neighboring fields, and dealing with central bankers and other strange creatures who come from different areas. So, and Charles Kahn, you just heard, which is a leading payment economist, who just introduced you to some of his thinking about these issues. And our newbie in this round is Natasha de Terán, which has not been introduced yet, so it's my pleasure to welcome you to this panel. You worked in journalism, in the financial sector, and as a policy advisor. And I had the pleasure to read a fantastic book you co-wrote, which is called Pay Off, and which gives a marvelous introduction to the ordinary economist and other guys to what's going on in the payment sector from a practical and intelligible point of view, which I found fantastic and very illuminating. So thanks for being here and joining us for a debate on issues of security and privacy in payments, which we want to focus, because we're in a central bank, on the pressing issue of central bank digital currency, which used to be a topic of academic interest. Maybe all of us have come across it as a theoretical construct many years back, but it's now, since a few years, have become a project in most central banks. I would say hundreds of central banks across the world are engaged currently in CBDC projects at various stages, and for all of them, one of the important issues, or two of the important issues, are how to deal with security and privacy within these projects. Hardly any of them have decided whether to launch anything like that. But it's a pressing issue, so we are not just interested, we are in desperate need of advice with respect to these issues in our ongoing project work. So let me start the debate by asking a stupid economist question. If, in a very blunt way, if you approach the issue of CBDC, say, well, there's already established digital payments market in most of our currencies, which is dominated by banks and payment service providers. There are established standards for security and privacy in this established market. So all the central bank is doing when bringing a CBDC to the market is just joining other established player in an established market and trying to find a niche for it. Why not apply existing standards on security and privacy to CBDC? End of the debate. Or why not? What would be your take? May I ask Natasha to share our thoughts, because you're
the least qualified to answer. So I'm going to lower the tone. So I think the question of privacy is a bit like nudity. When we're born naked, and we don't care about being naked. We're quite happy to be naked at all times. Then we're told to care about being naked, and we do care, most of us, about being naked most of the time, and we worry about it. And I see an analogy between that and the question of privacy in a CBDC context. Suddenly a central bank is coming along into your life and asking you, do you care about privacy in payments? You've never thought about it. If you live in the UK, you really haven't thought about it. And if you have, frankly, you're on CCTV camera all the time anyway, so it doesn't matter what Visa and MasterCard do or don't know. But I do think the question is coming out of the blue, and you're asking people, we're asking people, the media and commentators are putting the question in isolation. The other thing I'd say is I care about privacy when I'm on a diet with my husband and I go and I buy an ice cream. I want to pay in cash for that purpose. Maybe if I buy an extra pair of shoes, I want that privacy. But the rest of the time, I don't care. So it's not about a universal privacy. And if we ask about privacy in a universal context, you're going to get a different answer. We need to disaggregate the question, I think.
Thank you. Neha, would you?
Sure, yeah. I mean, I think that's a really interesting framing. You know, a lot of people, and I hear a lot of conversations by economists and central bankers saying exactly this question of, you know, I don't think people actually care about privacy. When I ask them about it, you know, they don't understand it. And I just think we're asking the wrong questions. You know, I think if you go to someone and you say, would you like privacy in a hypothetical central bank digital currency? You know, it's not really something they've thought about before. It's not something they really care about. It's not top of mind. But I mean, I think when you start to say things like, would you like to be targeted by advertising based on whether or not you're pregnant? Would you like to be denied this operation because your insurance knows that you bought something over here, which means you might have a pre-existing condition. Then they suddenly, then people really start to care, right? So when it's grounded in actual harms that could happen, which is definitely a few links away from privacy in my payment system, but when people really, really, really care, I think they care a lot, and I think that there are also these larger societal things that are happening right now that are a result of the fact that so much of our data has been digitized. Using machine learning and AI to make decisions. There was a project at MIT about recidivism in prisons, and these algorithms that would decide if someone was highly likely to commit a crime again, and that was used. This data, these algorithms were used in bail hearings, and this was really disturbing, and this really worried a lot of people. Because there wasn't a lot of transparency into how these algorithms are being used. I think you have to understand those algorithms are a direct result of all of the data that is being collected about us. And once that data has been collected, it's there. Once the data is out there, it's done. You can't take it back. It exists. It's in someone's database. You can't recall it, the way Microsoft Outlook tried to teach us that we could recall emails. Hopefully you all know that that's not the case. You just get 2 emails, the first one and then the recall email. And so I think that there are these larger societal sort of things at play as well. So I don't think it's fair to just go to individuals on the street and ask them a survey question about privacy. I think you have to look at all of this holistically. You have to look at this many hops down the chain. It's actually quite a bit of a complex problem. And when you start to do that, you realize it all starts with the data being available in the first place. And if we could change our systems so that so much data wasn't available, or at least that users had autonomy in choosing what data they wanted to make available instead of it all being stored in a database by default, I think we'd have different results.
Thank you. Charles, would you add on this?
Yes, 2 points coming off of from what you just said. First of all, I absolutely agree that you can't talk about privacy in general and in the abstract. That in fact, I want privacy for different transactions for different reasons. I care about it at different levels for different reasons, depending upon whether it's embarrassment or political beliefs or whatever. So it has to be split down in much smaller examples. But it is also important to understand that that context, it matters for this. But I think we have a good example of context showing how important people do believe privacy is. And that is an example that came from Canada in a couple of years ago, when there was a large-scale protest. People brought bunches of tractors into Ottawa, blocked the streets in Ottawa. And in response to this, the government used its emergency powers to block their payments, to block their bank accounts. At that point, the idea of CBDC suddenly became intolerable to an awful lot of people in Canada. Now, was the decision by the government a good thing or a bad thing? Most people would probably base that on whether they thought the protests were a good thing or a bad thing. But the answer of, yes, governments have particular power that make it not just the same as anybody else providing a CBDC, providing a payment system, that there's going to be extra scrutiny over what it means for the privacy, when it is a government-sponsored electronic payment system.
Well, can I jump in on that? So I think you two are both American. And those non-Americans in the room will probably find themselves in countries which depend entirely on American payment systems. Right. So we don't need to worry only about our own governments, when we have plenty enough to worry about that, but we also have to worry about your government.
Absolutely, absolutely.
So I think it's in that context we need to worry about the government behind the central bank that gives us the CBDC.
You mean you think that if it were only the Bank of England handling it, it wouldn't be a problem?
Of course it wouldn't. Charles, you know that. And Boris Johnson or Liz Truss behind them, it would be wonderful. No, but I think there is...
No, the extra layer makes it even more apparent.
Yes, and maybe a CBDC can be thought out as a national, or in the Eurozone context, a multinational opportunity to frame that dependence and decide what it looks like, as opposed to what we've all grown into.
Right.
And thank you. Most of you answered the question in about what do we know about users' preferences. Yeah, so we know that much. We don't know that much, and there's conflicts within users and lack of awareness. Maybe that's all are important issues. But in the context of an existing payment markets where there are many products, if you will, or services on offer with maybe all the same privacy attributes or maybe an existing differences. Is there a value in a CBDC offering different privacy features than existing payment products? That's be a different nuance to the question. Do you have any thoughts on this without referring to knowledge about users, which we have in very scarce supply?
Well, I would have thought yes.
Yeah.
Because if there's one organisation that doesn't have to turn a profit from the data, it's the central bank. And if the central bank is precluded from turning a profit from the use of our data, or maybe doesn't even have the data, it can set a baseline. But we could also talk about where the data is stored from a physical perspective, which comes back to the ownership of the payment system. If all the data from all American payment systems has to be stored in America, all bets are off on privacy, frankly. And that, that applies not only to how the US might interrogate that data, but how also our governments might extramuros interrogate that data through the US authorities. So I think that there's the one hand, there is the sort of national security, national control questions, but there's also the monetization ones. And certainly I feel at my age that I've walked, from pre-ATM years to ATMs and so forth to where we are today. I've never really made active decisions on how much data I'm giving whom. Frankly, if I wanted to now, I mean, I could spend an awful long time trying to work out who has my data for what purposes at what point in the transaction. And yeah, I've got better things to do.
Yeah, I think an interesting analogy is the encrypted messaging world, right? And what we've definitely seen there is appetite for different levels of privacy in messaging, right? And so you have people who, despite the fact that they have a default text messaging app on their phone, they'll install Signal. And in fact, you've even seen a lot of these default apps move more towards incorporating end-to-end privacy because of the existence of applications like Signal that showed that there was demand for end-to-end privacy in messaging. So, I think certainly, people are using different messaging apps because they have different features, and privacy is one of those differentiating features.
But using multiple apps because at different times they care about privacy more or less and care about other features that these things give more or less.
Yep.
The classic example of this would be, I guess, there's going to be a difference in my need for privacy when I'm doing a retail transaction and if I'm doing something that's an important financial transaction where the information about that might be expensive, and I'll be using different channels in each of these cases. Or if I want to not have it known that I've bought this particular house, and I'll have a whole legal structure built up to hide my ownership of this thing. So that was a fantasy. I don't have, but it is the case that and my daughter is of course aware entirely of how much. Which application that she might be using is appropriate for which circumstances because of which kinds of security it provides or which kinds of privacy it provides. And so although I can't distinguish between X, Y, and Z phone app, she does know that this one is good, safer for this, and this one's better for that. And I think that's actually the right way to go. Along those lines then, as you were saying, since the incentives for a central bank or government are different from the incentives for a profit-making institution, they're each going to be good at offering certain kinds of privacy and not so good at offering other kinds of privacy. And again, I'll want to be switching back and forth between the two, depending upon whether I'm worried about the political risk or the problem of being bombarded with spam.
Thank you. I forgot to mention that initially this panel included one other person, Boris Hemkemeyer, which is an IT security expert at Commerzbank. He faced a virus attack in the literal sense over the weekend, so he can't be with us for health reason. His greetings and our greetings to him. And I thought of him late, but better late than never, because we talked before, and he mentioned that he wants to remind central banks, when you issue a CBDC, you do not only enter a payment market, a market for payment instruments, but also a market for fraud, a dark market where you face attackers and mafia types who look at different payment services and look at which best to attack and where best to attack in order to reap a profit. So, and one of the features which makes one an attractive target is the privacy and security features one offers. So you have to be aware that you also you are active in different markets, whether you like it or not, and you have consequences for the whole market. If you offer a new product, you may yourself become a target, or because you're so well shielded, you may make your competitors a target in the private sector more than before. So that's from my perspective, an interesting point to make, which offers a lot of stuff for discussion, and I just wanted to throw it in among the three of us, among the three of you, if you had any thoughts or ideas on this quite original perspective, which I found interesting.
It's also a worrying perspective, because this is something that at the consumer level, the central banks are simply not used to dealing with. And so it's going to be something that puts a brake on any plans that they try to make. It takes all the time it takes to do the development because of the need to understand that better than they do now. So even though the statement is self-serving by a member of a commercial bank about how their expertise is great, it's still true that this is a real difficulty.
I think this also speaks to maybe remembering that the central bank doesn't have to do everything, and that there are different models for how something might be designed, right? And so, it doesn't necessarily have to be a standalone payment app provided solely by the central bank top to bottom, right? There's a lot of different models, there's a lot of different ways to think about issuing it, and there's ways to think about leveraging the private sector or payment service providers for more of that type of functionality, right? So sticking with the core competency of issuance as opposed to running an entirely new payment system top to bottom.
So against your urge to eliminate the intermediaries, you think there's, in the case for CBDC, something to be said in favor of an intermediated model?
I don't want to eliminate intermediaries. I want to minimize the harms that intermediaries can do. And I think that that doesn't necessarily mean removing them entirely all the time. It might mean regulating them. It might mean having a robust competitive market of them so that users have choice. Or it might mean certain architecture choices to limit what they can do.
Thank you.
If I can, on the fraud and security side. So, I mean, I think if we, as a citizen, I come at the payments problem from a. I need it to be ubiquitous. I need everybody to be able to use the system. I need the poorest immigrant to be able to pay and be paid, and I need the richest person to be paying with the same thing through the same system that allows the poor immigrant to receive money. And I need them at both ends. I need trust within that. Then everything else beyond that is kind of bells and whistles. And in the UK, which boasts to have the world's most sophisticated payment system, we can discuss whether that's the case. It is certainly the world's most sophisticated payment system, I think, when it comes to fraudsters. And that might be a factor of the English language, and it might be a factor of the You know, we might have high levels of criminality, who knows? But we have a very faster payment system. And it's a system of many systems, and guess what? Everyone within that system doesn't apply the same fraud controls, doesn't apply the same rigorous controls on money laundering and so forth that they should on the way in. And frankly, it is almost not fit for purpose at the moment with the amount of fraud we have in the system, which is devastating. Now, if you were a central bank or if you were Visa or MasterCard, you could come up with a system with a set of rules and everybody either plays by the rules or gets out. I think what we have in the UK is not dissimilar to what is occurring in the payment space in other countries around the world, is where you have this kind of, you have young banks, old banks, new banks, big banks, small banks, all trying variously to be in different payment systems which need different levels of investment, which different banks are more or less keen to be involved in. And actually the tech companies are far better, the fintechs are far better at doing what they're doing, but they're piggybacking on the back of everything. If I was a central bank, my goodness, to sort out this problem of fraud, which frankly is on my doorstep, even if I'm not the operator of any of these systems, I need my money to be trusted and ubiquitously accessible. And it's not if the system isn't fit for purpose. Then I would want a whip strong enough to enable me to eradicate this fraud problem. And if that's a CBDC, that's a CBDC. Mm-hmm. I think the question to me, as standing back from it as a citizen, is what is it going to take to make our money system work for everybody in 5 years' time? Mm-hmm. Mm-hmm. Given where we are today, which is already not perfect.
So more consistency would be a promise.
More consistency. Yes, I mean, I think when any market goes through an evolution, it's messy. We've been going through a very messy evolution for a long time, and payments, I think, over history has always done this, and then you have to, you guys play catch up. Pick up the pieces and pick up the pieces. But where we are now, it's such a transition to the digital economy, and we can talk about whether cash is good and should survive. Maybe, maybe not. The cash dependent, you know, it's not a problem for central banks to solve for, but if you are completely cash dependent, you are paying more for less. Your access to life is restricted. So you could take the view that a central bank that continues to offer cash is subjugating the poorest of the poor. And I think there's a good argument for saying that the lift has to be the other way. But we can get into conversations whether you can digitize cash and keep its benefits. Right. But I think it is a monumental time that we're facing that requires monumental changes and questions. Whether a CBDC is the answer or there can be a private alternative, I don't know.
I mean, it touches on an issue which you introduced today, the advantages of cash and the inclusionary features of cash, which I, as a central bank, we totally agree, and it's it's fantastic that someone else supports us in our arguments. And I just wanted to say, in the euro era, when we are talking about whether to issue a CBDC, we always say it's not to replace cash, and it's intended as an add-on, and we do not intend to stop it, because there's no way to exactly digitalize cash with all its desirable features in the electronic way, and there's the material aspects of cash. They're an asset in themselves from a user perspective. So if we can, we try to still produce cash whenever we issue a CBDC. So that's kind of relief of the necessity to find the golden egg or whatever, and to do the impossible, and finally come to terms with the difficult technical challenges in finding a digital equivalent to cash. But still coming back to CBDC, that's complementary to other means of payments, including cash. And being faced with the decision how to deal with privacy issues around CBDC. One key problem is the trade-offs for various policy objectives, how to deal with AML, KYC, because you call this the ambivalence of privacy from a user perspective, and of course also from a social perspective. We care about privacy in transactions because it prevents transaction partners from possible harm done by third parties or their partners. But there's also a potential cost to privacy if the transaction goes wrong. One of the transaction partners has to bear this cost, or if the transaction hurts third parties, then there's a cost to society. And there's a cost-benefit analysis to be done when you decide as an issuer on the privacy features offered on your payment instrument. And in CBDC projects, I think the widely discussed solution for this trade-off or cost-benefit analysis is to try to achieve for special use cases, small value payments, offline payments, up to a specific thresholds, grant them more privacy features and less privacy for high volume, standard online payments. And that's, I guess, one important proposal to deal with this cost and benefit of privacy. And I wanted to take the opportunity to have you here. What is your view on this proposal? Is it technically feasible to have offline payments, for instance? This is still unsure, and is it useful from a user perspective? It's a good balance? What are your views on this?
I have really more questions. I'd like to know the answers to these kinds of questions. It seems
that's not allowed.
Okay, because it seems like one of the things that has always allowed us to use cash for small value purchases under privacy is the difficulty of carrying around suitcases of the stuff. That the amalgamation is that the physical limitations are the safety, and that goes away. Can it be? Can those protections still be there if you can no longer control scale of individual payments? What are the tricks out there for this?
Yeah. So, well, I guess first of all, I think privacy for small value payments is starting stakes. Like, yes, absolutely, we need that. That's the minimum that we need. And I was heartened that most of the central banks I talked to were willing to consider something like that. But the challenge, I think, is if you don't have some form of identifying people, then how do you rate limit or meter the small payments, right? So that's the issue. And so then that gets into, well, are there other sort of ways of rate limiting or metering small value payments to try to mimic this physically of cash, right? It's hard to carry around a suitcase of cash. It's not impossible to carry around a suitcase of cash. You know, it's not like at some point it becomes too heavy and you can't move it anymore, right? Which is sort of the analogy.
But the costs go up.
Yeah, the costs go up. So, but it isn't like a threshold, right? It's not like a. And so, you know, is there some way to mimic that kind of property? And would that be sufficient? I don't know. I mean, you know, you can think of ways of mimicking that kind of difficulty property. Like, funnily enough, we have one in blockchains. It's called proof of work, right? But I mean, I don't think you should apply proof of work to small value payments. But it's an interesting question of, is there some way to kind of mimic that? The way that I've seen people address it is using something akin to anonymous credentials. So basically, you've given most people an identity, you've rate limited these identities in some way, and they can present these identities anonymously when they make their small value payment. So it doesn't necessarily reveal who they are, but they have to have authenticated or gotten some kind of rate-limited identity somewhere else. So that's the technique that I've seen, though others in this room or from the previous conference might have more ideas on good ways to do that.
But that maybe fits with the intermediated model where you delegate identification.
Someone needs to assign the credentials
to some other institution, which then
and I want to stress, like, these
splits up data.
These like credentials don't need to be heavyweight. They don't need to mean I have a driver's license or a passport. They could be as simple as I walked into this corner shop and I bought a small card, and that card lets me make, gives me the authority to make a certain number of small value payments. And then I have to go to another corner shop and get another card. But that kind of mimics the difficulty. It's hard to go to a corner shop and buy 100 of these cards at once, right? And it's hard to go and canvas a physical area. So you could imagine having sort of this, in-person physicality, ways that don't require you to have strong form of identities. Obviously, if you've authenticated with a bank or a commercial institution, they could, you could imagine different ways of maybe having these sort of tiered forms of essentially, preventing what we call in computer science Sybil attacks, or someone who can manufacture identities out of nowhere.
It would be the kind of the prepaid cards model, which is certainly limited in here.
Yes.
If I can, I think it brings home this conversation to me to quite how national or regional these conversations need to be. In Britain, frankly, if you had small change, there's nothing you could do with it. You wouldn't be able to get on a bus, you wouldn't be able to get on a tube, you wouldn't find a coffee shop that accepted it. There will be no point in coming up with a means, making the CBDC, used anonymously for small amounts. There would be no point because no one is moving small amounts of cash. So, I think in the Eurozone, you've got a much more complex matrix of countries to deal with and much more plural needs. But I think we should also be thinking forwards. Not every country will necessarily move in the same direction, but the use of cash is falling all the time. And not every transport provider wants to deal with coins. I haven't got onto a bus yet, but I'll be interested to find out whether if I had some euros, they would be of use to me. I don't know.
We're a cash-loving country.
Yeah, but I don't think we should be solving.
It's because they love the central banks.
I don't think one should be solving for the past, or for very. I think this conversation can get so tied up by the niche concerns who speak the loudest and object the loudest. I think we need to stand back a bit. What are we really trying to solve for?
That's fair.
Okay, I was hoping you would pick up on the offline payments functionality, which we endeavor. You didn't, so I'll press you. Do you have something to
Doesn't
say
the
on
digital
this?
euro support offline payments already?
We hope so, but I think we're in the process of finding a good solution for this. But this is something policymakers encourage to develop, and a feature which is under development, and there's no marketable solution to this as far as I understand yet. So it's a research project, and I've heard at other conferences technologists frown at even the chutzpah of trying to achieve something like this, because there's some issues with
well, I think this is actually another interesting place where we can learn from the developing world. So most of the technology research I've seen in the field of offline payments has really focused on contexts where there isn't good internet access. And so, 10 or 20 years ago, that was certain parts of the developing world. I don't know that that's really the case anymore, but so there were, research projects that were designed to try to do payments in these contexts. From what I've seen, they all come with trade-offs. So, you have to limit the amount of times a payment can be made while offline, because there's always a risk of fraud. You have to sort of assume the robustness of trusted hardware. So there's always these trade-offs. And so it's always just about, I think instead of, asking, is it possible or impossible, it's really, what does the trade-off space look like? What are the things that are most important to us? Are there ways that we can accommodate risks in this trade-off space? So, just a little bit concretely, I think I said this during the questions to one of the questions earlier. Instead of saying, can this never be broken? What happens when this is broken? What's the mediating strategy? Can we bound the amount of fraud that could happen if this gets broken?
That's the escape key thought. I think you're very much on the same path.
And what are the rules and regulations by which these new standards will be put into place when the new emergency comes?
Yeah, right.
Intimidating.
Intimidating. I'll write that down. So we talked about how to design privacy, how much privacy, solving trade-offs from a designer perspective. And when we're finished with that, there's a huge challenge still ahead of us, how to, and some of you talked about this already in your keynotes, how to make these features credible to potential users, because however robust and fantastic your technical or incentive solution is, you want users to be convinced and they won't be tech wizards able to verify your claims. They need to trust it, and what's the story you can credibly tell them that's a major inconvenience shy central bankers face because they're not that good in marketizing their products. So the issue of credibility and the security features to prevent disappointments in privacy expectation, because from a self-interest point, we have a reputation to protect and a trust in our ability to provide sound money to defend. So the act of issuing CBDC and promising some features it will have is in itself a risk. We endeavor, and we're very concerned about that. So that's why we ask you. What's your solution? 3 words.
I presume you're going to have some sexy PSPs out there doing all the front-facing marketing.
Yeah.
So you don't need to worry about that. I think the big problem is, why is central bank money better than commercial bank money anyway? And you don't really want to be having that conversation with, I'm guessing, the world at large. But that is the promise that you're making with a CBDC. And to explain that promise to your population is if they understand what you're saying to them, then that's a mixed blessing, I'd say, for your commercial banking system.
It's not very encouraging.
But it's an old problem because, in fact, central bank money versus private money has been a theme through history, and the differences between the safety of the two and the extra conveniences and bells and whistles that the unstayed private banks gave on their slightly riskier offerings. The answer, I guess, is you always want to be thought of as the most staid one around. And I think that's an easily achievable thing for central banks. Mm-hmm. they have good experience at being staid. Mm.
Yeah, I would agree with that. I don't think it's about fancy bells and whistles or trying to have features. I'm also, to be frank, not very good at marketing. And so I wouldn't approach this from a marketing perspective, but instead would look at this as building something people actually need and want. So build something very simple, very safe, that people can trust, and that that they actually need and want. And I think if you can do that, you also, I guess I'm a little confused because in some ways you talk about marketing it to get more people to use it, then you're worried too many people will use it and it'll destroy the banking system. And so it's, you know, you gotta, gotta just find your middle ground of what you're aiming for, maybe.
Does that argue for starting out with niche uses? Here's a specific thing we're doing with this, not answering the question of we're going to do it for everything, but here is a use. Get confidence in that before you try. Tailor the. It actually poses a problem because everyone out there has a different notion of what a CBDC should be doing, and so, like all committees, you want to do all of those things, and actually that might be the mistake. It might be precisely the wrong way to go. The way to go is to say, here is a use, and this is all we're talking about right now. If it grows later, that's wonderful.
Yeah, that's certainly good advice, and the tried and tested approach to launch a new payment system.
Right.
But maybe easier in not that mature systems,
yes,
and not so easy in very mature digital equipped systems. But yeah, still worth considering. Let's explore the relation to new payment instruments. We touched upon that already. So far we talked about other payment service providers in domestic currency, but an often mentioned threat or reason or motivation to work on CBDC is the perceived threat of non-domestic and not yet present private parties issuing digital means of payment in their own currencies or new currencies or even our currencies with different features like foreign currency CBDCs and globally active big tech firms which in the wake of Libra and DM rediscover some variant of this and try to launch it in conjunction with market power in a foreign market which translates, or parts of our market which translates into good prospects to get a foothold on our turf. So CBDC design is often seen as facing challenges from these sources, but also from security attacks from malignant actors abroad. And this challenge is often framed as a technological arms race. We must be better at technology and equip CBDC with newest technology in order to keep up with this arms race. Do you think this is a useful perspective to inform our work, or is this a kind of a wrong perception?
Oh.
Who's brave enough to try that one?
I think the key is not to have too many enemies, because I think the technology stack is so complex, and I don't think. I mean, certainly not an island like Britain wouldn't be in a position to build its entire infrastructure top to bottom. And we've sold all our assets long ago anyway. I think, I can't remember what the first part of your question was, but I was going to comment on
challenges from abroad and the private sector, challenges from the new.
Well, obviously, abroad is a terrifying prospect. God forbid that we'd have to accept someone else's currency. But I do seriously think it's a very frightening thing that your nation might splinter its currency. And I don't say that just as a central bank, but to exist in a nation in which we can't all interact economically with the same instrument is a very frightening scenario for me. And it becomes, with technology, it's not just the assets, it's also the systems, because when we had notes, the note worked everywhere unless it was Scottish. But seriously, it's foundational for society that is the case. And for me, if there's one thing that a CBDC or the CBDC debate has to solve for. It's ensuring that everybody, without cash being as present as it was 50 years ago, it might survive, it might not, doesn't matter. It's not as useful today as it was 50 years ago, except in Austria. That's what we need to solve for in these discussions, I think. How can we make sure that the duopoly doesn't tax us too much, that banks reach decent settlement timeframes and get away from fraud, and that all of these systems interact with each other properly without 4-day settlement times and 3% interchange fees, all of which go back to the States. Sorry.
Seigniorage is great stuff.
But I think that potential development of payment silos within a nation is really frightening. It's really frightening.
But I think that the systems are more robust than this notion of threat, even now, than this notion of thinking of it as an imminent threat. And I take as the analogy, and it's not a perfect analogy, I admit, but countries that have gone through but chronic large inflations still have not had their money usurped by foreign money. There's an awful lot of inertia in this system. Now, you can always, it was different than it's different now than it was then, but I'm not so sure it is. That convenience of being linked to the predominant one is a very powerful statement. It's going to take an awful long time for some other system to usurp to the point where that advantage goes away. And so there's going to be time there. I mean, yeah.
But wouldn't you agree the trend line is in the direction of, money is less local and more global now?
I don't know. That's true. Have any of you tried paying with dollar bills here lately? I admit that yes, my credit card does work, but it's still.
Or I guess I'm thinking about, anecdotally, stablecoin usage in Latin America and Argentina.
Oh,
right? Like people are trying
to
get their hands on the
fair,
dollar
and fair enough. Those levels of difficulty are levels of difficulty that would not have been big enough to make switches over into physical dollars. That is a fair statement. Yes. I agree that there is a difference here, but I think there's more time than the panicky kind of reactions give. I think it's an argument. It's certainly an argument for being prepared for, being ready to understand how to do it. But I don't know whether it's an argument for getting it out there immediately.
I mean, I think the national barriers are well and truly in place, and those that aren't imposed by the central banks are imposed by the commercial banks and MasterCard and Visa, all of whom extract money every time there's a border that pops up.
Right.
So I think we're still there.
So we used up half of the time, if my watch is correct. So I'd like to open the debate and give the audience the opportunity to interact with
and tell
our
us
panelists.
why we're all wrong, right?
You're right. And give you the opportunity to share your wisdom for better questions.
Hi, everyone. Edona Rashidi from the IMF. Thank you very much for the great discussion so far. I'm curious to know your thoughts around this observation or fact that whenever we talk about CBDC, privacy and fraud concerns always come up. But whenever central banks deploy other public infrastructures, let's say fast payment systems, this area is not talked or covered at all. Take the case of Brazil, PIX is deployed. The information of users, the encrypted information of users is operated, the database is operated by the Central Bank of Brazil, and same concerns that could arise with CBDC, very similar, could also arise with fast payment systems. But this is something that's not brought up as a concern. Is it just because central bankers are sort of doing more harm than good discussing this when it comes to CBDC, or is there something else to think about? Thank you.
Can I comment as a former journalist? When a central bank redoes its RTGS, no one writes about it. So it doesn't matter. When the RTGS fails, then they'll write about it, and the central bank will get told off. CBDC journalists sort of think they ought to be writing about it, and then think, well, how can I write about it? Oh, yes, fear, something bad. And, you know, Manic Hamster is front page. It's not. So I think there's that, how do you make this
sexy?
Sexy. How do you bring it to somebody? And, yeah, I mean, I think the commercial central bank money question is one that could sensibly be out there a bit more. I think the Visa, MasterCard, the fees, the settlement times. But all of these things require that journalists know the landscape. And, you know, increasingly or decreasingly, that's the case, certainly in the English language press. I think that there's very few specialists who will get under the weeds in that sort of area.
I think there are two pieces to the story. To the extent that the faster payments arrangements are not directly linked to the central bank, then that protection leaves the concerns to be less. In places like Brazil, where it was much more obvious that this was a central bank operation, you might have expected that to have more concern about fraud and privacy. So, but in Brazil, the overwhelming issue was access, and so that may have swamped the concern about the other issues. Whereas in a country where there's greater access already, you might not have that same relaxed view. If it were a faster payment system that was obviously visible that the central bank was in charge of it. FedNow is, you know, sort of hidden behind everything else, so it may be able to get away with this without having anybody raise those kinds of questions.
Other questions? Yeah.
Thank you so much. Thank you. So at the beginning of the conversation, there was a bit of a discussion. Well, I mean, privacy has been a theme, obviously, throughout the whole session, but talking about incentives for privacy, and we're talking about education right now. So there's a result that I have in a recent paper where I find basically using some data on vulnerabilities at the firm level for Fortune 500 companies, where it seems like firms, basically the market isn't fully pricing cybersecurity risk. And so finding that high vulnerability firms have lower excess returns, low vulnerability firms have higher excess returns. Mm-hmm. So this would suggest that there's some mispricing in the market. Now, that's a large statement, and I don't mean to, I mean, I don't want to say just go with me on it, but essentially I want to ask that question. Do you think that there are sufficient incentives? Because there's consumer education, that's one aspect, but then there's also incentives in the market, and whether or not executives, CISOs, and other sorts of chief executives are being properly held accountable when there are data breaches, other sorts of vulnerabilities, and all the issues that were pre-CBDC carry over into a CBDC discussion as well. Thank you.
That one too. Salience is going to matter a lot in that story, isn't it? I mean, I would want to see whether those watch those excess returns around events which get high news coverage and see whether or not the same story arises. Is it the case?
Yeah. So news is a mechanism through, and so we use like Google search to look at investor attention as a proxy, and so that hypothesis is very much the case that it's a mechanism.
But that cuts two different ways, of course. Whenever one of these dramatic events happens, then you're going to see that happen. But when people get used to them, that also may make it less important. Oh, yeah, it was another breach, and there are a million guys, and I'm only one, so it's not going to matter to me at all.
Yeah.
So it may be actually properly evaluating it in that respect, because there may be more panic about this from individuals from watching the news than there is actually cost in terms of the damage to the individuals.
Do you want to add something?
No, I mean, the only thing I'd say in relation to the consistent data breach at companies, or breaches, which I expect will persist no matter what, is every single time there's one of these, almost every time, I get a message saying, so we only held your payment data, don't worry about it. So going back to your question of the privacy, and so long as it's easy for me to pay, they can have my payment data, they've got my payment data, they've got my details. I think we are kind of lazy about those sort of things. Well, I am. I
don't know about lazy. I've thought about trying to become more. No way.
You get locked out.
Yeah. There's also a question about privacy. At the start of the panel discussion, Natasha also raised the issue that it's very national dependent or cultural dependent. So for a couple of years ago, I did a project in Norway about CBDC together with Cyril Monet. And when I raised the issue of privacy, they started to smile a bit in the sense it was no issue. Because perhaps for Sweden it also holds, but for the Norwegians, the trust in their institutions and in the government is clearly so high that they don't sort of care about privacy in their payment behavior at all, because they think the government is doing their best and we trust that. If you would, so that is the Nordics in some sense. This holds probably not for Italians and that perhaps have another level of trust in their own institutional arrangements, or, well, Austria is a cash-loving country, and also when you saw the report, one of the first reports on the digital euro, when citizens were asked about how they would feel about it, then 70% of the respondents said that privacy is a big issue. So I want to stress it is very difficult to talk about privacy independent from country to country, because it is also sort of culturally almost determined how you feel about it. I think a lot has to do also with institutional perception and how you trust your own institutions and stuff. Yeah. I don't know, is this a question or a comment? But I want to raise it.
That's fair. So when you're a theoretical economist, you can still write the model, but you have to put in very different parameters when you're talking one country to the next. Yeah.
And I don't know that I distinguish between a trust in the system, the judicial system and so forth, the legal system, and the politicians. I think there's one level of trust in the system, and there can be mistrust in the politicians. I think when there's no trust in the system, then the privacy argument becomes much more important. Yeah. But I think there's history, there's habits, and then if we want to get onto the identity question. So Britain, we don't care about privacy, but we won't have an identity. So how are we going to deal with the CBDC? And that's another question. Whereas in Germany, big concern about privacy, but no concern at all about having a national identity card. So it's very different.
You talked a lot about privacy. One thing which wasn't covered so far is the default risk of banks, or actually having a means for normal people to have euros and savings without being exposed to the default risk of a bank. And in this, I have two questions. One is, do you think it would make the banking system better if there is a alternative in which you do not have a counterparty risk, which means that educates the bank needs to care more about that? And second question, possibly a bit polemic, as banks get bailed out with taxpayers' monies, don't you think you owe to the taxpayers to offer such a counterparty risk-free system where you can store your money?
This is just a moderator. This is hard.
Okay, I'll start. First of all, I don't think there is counterparty risk in the banking system. In the regulated banking system, in the banking system, there isn't, because there's deposit protection, 85,000 euros, give or take, and CFPB, I'm not sure. But the consumers have forgotten about Northern Rock and Lehman and all those things because they were decades ago. And the average consumer, I don't think, is distinguishing between PayPal and Barclays. They should be. they're probably not distinguishing. If they've got 85,000, more than 85, they're probably splitting it, which is good. But we wouldn't see all the money that there is sitting in all of these non-bank payment providers if people knew that they were at risk there. Now, are those non-bank payment providers sometimes better at the bells and whistles than the banks? Yeah. Will they always be? Probably, because they don't have 100 years of legacy infrastructure that they still haven't knitted together. They'll certainly be better for the next 10 years, but then there'll be another better one, because anyone that's looked at the back end of Meta will know perfectly well that if they'd done Libra, we'd be in much more trouble than anyone could ever imagine. So I don't think it's counterparty risk within the banking system. Let's hope not. We have systems in place to protect against that. Yes, one might go bust, but we'll get made good. But the problem is the consumer isn't distinguishing between a bank and a not bank. And I think it probably depends country to country, but I've got a 17-year-old. She doesn't know what a bank is. She doesn't even see a bank. There's no banks for her to see. She wouldn't, the idea that, there's big clearing banks, but what does that means nothing to her. It's what's on her phone. And she's probably an educated 17-year-old with protections around her, like a bossy mother. Mm. But there's a lot of children who aren't in that position, and they wouldn't, So I think it's thinking behind the knowledge that you all have, and then thinking about counterparty risk to all those people that are doing other things, and why they're doing them, and what do they understand. And trust in money will evaporate when a PayPal goes down. It's not just PayPal that will have the problem. The entire financial system will have the problem of a loss of trust, I think.
Pushing further along those lines, one of the issues, and this is always, one of the concerns has been, you put this CBDC out there, and you make it therefore easier for individuals to, if they do not trust, if something does go wrong with the bank, the monies flow out faster than they would have otherwise. And that's just one more step from now they can get it out of ATM machines much more quickly than they could have gotten it out by having to go to the bank in the first place. So it's just another step along the way, and the same trade-off arises there of, well, yes, you have the potential of making things less stable, and maybe that's a terrible thing, or maybe it's a good thing because that means that they'll be more careful in response to that, and who knows which way that balance goes, because we've seen it happen both sides on that same story. So I don't know that. I think we know the theoretical answers of, well, it depends on which one of these is more important, and I have no idea what the empirical story would be the next time it happens to see whether this is a good thing or a bad thing until we run the experiment. As far as, no, thank you. I don't. Once every 30 years. Yes. Once every 30 years or so.
We'll be retired.
Yeah, exactly. I'm already retired. What I guess I don't see as a serious issue in that story, though, is the question of should we do it as a compensation for the fact that they got such a good deal as bankers, maybe we should be getting a good deal as the poor individual consumers in this story. If that's your real concern there, then the right way of handling that is with the right kinds of sanctions on failed banks or failed bankers, rather than trying to do it as a subsidy of me because I'm not a banker.
Yeah, thanks. Thanks for the discussion. I had a talk, so I had a question regarding, you discussed at some points in how far do central banks need to market, a CBDC, and so that made me think, in how far do you think the market for money is a free market, and there should be expect competition between different currencies, say, I don't know, a Bitcoin or something like that, and how far do you feel that later we will have different currencies coexist between each other, and do you think a central bank digital currency will be able to survive within this market, other than, well, by decree, how do you see that for you?
It's okay. Would you think in that question, would you think of bank money as a separate thing from cash. Do I want to think about my checking account? I'm from the U.S. We still call them checking accounts. Do I want to think about my checking account as a different money from the dollar bills that are in my pocket? Because I mean, in some respects, that's a competition too. So in some respects, we've already had this kind of competition going on, and so I'm not sure what it is that's different about saying, well, we're going to put one more mode of payment in as part of the competition. Where it gets tricky is when these various kinds of monies get different exchange rates. And that one becomes a real problem for a country because it's just a pain in the neck for people, at least traditionally. Now with phones which do long division for you automatically, it may not be such a big deal. Who cares who cares whether I decide to pay in dollars or euro when I sent the credit card bill in? In which case, it becomes also not an issue of what used to be a really important consideration. We don't want to split. We don't want to have division between the kinds of currencies that can be used. Might become less of a problem under those circumstances. Either way, I guess the question of whether a CBDC would survive in this world depends on the use cases. Is it the case that we've designed this CBDC to be useful for particular uses that people really want? And if so, yeah, it'll be out there just fine. And if we don't have good uses for it, it's not going to survive no matter what.
Yeah, I think building on that a little bit, I don't really think this has anything to do with CBDC, but I do think we are moving towards a world where technology is making instantaneous exchange a lot easier, and a lot easier both to happen in the back end and also for consumers to understand and comprehend. And so I could imagine way far in the future, I keep most of my assets in whatever, matches my preferences for risk tolerance and yield and stability and whatever. And, when I make a payment, sort of very quick, instantaneous, cheap exchange is happening in the background in markets with a lot of liquidity. And so it almost matters a lot. It matters a lot less what I pay in. And, what I hold might change as well. I might start to move from holding cash or holding amounts in checking accounts to holding more yield-bearing assets. And because you can imagine it just becomes everything becomes much faster and more liquid. And so things begin to compete even more.
At which point monetary policy becomes really an interesting problem.
Mm-hmm. I would disagree. Sorry, I would really disagree. I think it doesn't matter where we save our monies. It can be in euros, dollars, pounds, it could be in stock shares or anything else, doesn't matter. I think what we pay in as a community, a trading community, a social community, that matters. Why does it matter? It matters because every time there's an exchange, there's a cost and there's a friction. And if there wasn't, then guess what? There wouldn't be an exchange because no one would be running a system for free. The only person that's going to run a system for free is the central bank. And unless you've got two central banks in a nation, you're not going to get two sets of free. So you don't want that. But I think if we look at all the monetary systems that we have, with better or worse currencies, it doesn't matter. None of them are perfect. It's within the dollar confines that dollar fraud occurs, that money laundering occurs or doesn't occur. Same with sterling, same with euro. If we add to those systems when we haven't sorted out the systems in which it's imperfect to move money, fraudsters operate, that there's all the problems that we know, you would just be duplicating the problem before you'd solved the first problem. So I think it would be an incredibly retrograde step to have multiple currency activity within
activity for typical transactions.
But don't we, literally every time I swipe my credit card here in Austria, it asks me if I want to pay in USD or euros.
Yeah, it's just asking you quite how much you want to be taxed.
Exactly. But why would they even do that if there was always a right answer?
Because they've been told they have to, and they're shortly to... In other places, they've been told they're not allowed to ask you because if you answer the question in dollars, I think, you pay more.
Yeah, I know. I assume that they're bumping up the exchange rate, but at the same time, it exists, which is a bit strange. I guess just to say sometimes... Maybe there are I agree with you, whenever there's an exchange, there's a cost, but maybe there's some other cost, some convenience or something else that counteracts that cost.
I couldn't, well, I'd have to be convinced that there would be a convenience in introducing a new currency within a currency zone. Yeah. I can't.
It would have to be a convenience coming off of the services of that currency offered to you, and whatever those might be.
I think it's kind of similar to like in certain cities and certain neighborhoods, you can pay with Alipay or WeChat Pay outside of China, right? It's a new payment app, but you know, if there's enough market share, there's enough network connection that it's become worth it to start to support that new payment system.
The real problem then becomes when it is the case that you are the exception that only have WeChat Alipay or only have dollar bills in your pocket, and then it's the edges where that starts really mattering. For those who have convertible credit cards, it's not an issue at all.
Yeah. I think also there's a risk if one did have this sort of maybe currency within the currency. Like all other parts of the payments industry, it would seek to serve the richest, the affluent, and then the richest, then the affluent majority, then the affluent minority, and so on and so forth. But the people that can least afford to pay for paying are never going to get served by this commercial provider. And you would have this fragmentation of the system that, as ever, the poorest would end up paying for the conversion.
But then the answer for that is going to have to be back to saying we want the central bank system to be the plain vanilla version of whatever it is we're going to be doing. Extra stuff, you want to pay for it, that's fine. You can get another private system on top of that. So any system, you want the baseline out there to be the central bank system, and so that's an argument that you want the CBDC to be a particularly simple structure, so it can always be provided and always available for people.
Thank you. There's another.
Yes, thank you for the discussion. I have two questions. The first one is maybe an understanding question. So I wonder why CBDCs designs that are discussed always have this offline payment use case. So we heard a nice presentation today of all the good properties of cash, and they were widely agreed on. And the only thing basically cash was missing is this online payment opportunity. So why not focus on this and basically deal with all the additional trust assumptions which are even in the name trusted hardware you need to support this offline use case? Why not focus on the online use case first for CBDCs and do this one right? And my second question is regarding the question of trust, which was also brought up during the discussion. So one method, especially in the computer science or security community in general, to ensure trust is to basically be transparent and have transparent schemes which are public. So a common way of achieving this is that, especially in cryptography, that everything about the system except the used cryptographic keys should be public or common knowledge to ensure that the system lives up to its guarantees and fulfills its security and privacy guarantees. So is there maybe something in this direction upcoming to ensure this transparency, to gain this trust?
Let me answer on the offline thing first. I think it points out the importance of realizing that different countries, when thinking about CBDCs, have had different use cases in mind. And in some of those countries, the offline use case is in fact the most important one for them to think about. The example is the Bahamas, where a major argument in favor of a CBDC was hurricanes. That is, we want something that it didn't work this way, but the goal was we want something that's going to work when the hurricane hits. And if that's the case, then you really want to talk about the offline powers of it.
Is this also true for the European Union or countries in the European Union, that there is this offline demand as strong?
And also in the discussions in Canada, it's always been thought that, well, you know, this is a big country. There's big parts of it where internet services are unreliable, underserved communities. We want to make sure that this is part of the story. So I think that part of the reason for the emphasis on it has depended upon which particular use cases you've been looking at to see what it is that you wanted your CBDC to do.
My understanding with the digital euro, because I think he's pointing out, you know, maybe offline isn't obviously as huge a need in the European Union, but the digital euro is emphasized offline.
Right.
my understanding is that it was in some ways to differentiate from existing digital payment options. So, you know, none of the existing digital payment options provide offline. So maybe that's a way of differentiating this and providing value.
But may I step in agreement with you? This is not an either-or question in plans for the digital euro. Of course, the online facility is, should be provided and will be provided if it's issued, but offline is the more tricky use case, so it makes sense to focus on it when you're together with experts, and because there are a lot of unresolved issues. We pay online for decades, so that's not that much of an issue to be solved, but there's no marketable solution for offline payments yet, so it would be something new, and we don't know if there's much demand for it, but maybe yes, maybe not, but it would be a new thing and would be appealing, as you said, maybe to distinguish oneself and offer, hey, here's something new, something which you don't know, pay attention. Thank you for your point.
I think, can I just ask, it's an interesting conundrum for a central bank, though, because if you produce a CBDC for everybody, you've got to make it available to everybody. And if some of everybody decides they're not going to be online for whatever reason, then how are you providing it to that everybody that's not online? And that's, you may have pockets of the country that are not very much online because coverage is terrible. That might be solved for technically by a bit of investment and a nudge to the Department of Telecoms. But those that will not participate online, how are you going to make this new instrument available to them if they won't? And I think that is, from a taxpayer perspective, from a societal perspective, that's an interesting conundrum.
And but what do you say to the transparency
that's
proposal?
That's another interesting one. I guess I'm a little skeptical of the ability of me as a non-computer science person to understand whether or not they got it right in the open arrangements or to know who it is I'm supposed to look at to get the certification for this kind of a trust. So I'm not sure that the solution that computer science thinks of as the obvious solution is actually the solution that would actually sell to the guy who's not a computer scientist. And so maybe that's a problem, because in that respect, the trust is going to have to come out of trust of the institutions that are announcing this, whatever those institutions are. And that's a really tricky question of how to make that work. Now, I agree that on the technical side, to make it truly trustworthy, you do want to do precisely the kinds of procedures that you're suggesting. But I don't think that's going to solve the man on the street kind of problem of trust.
I'm not sure. I guess it could help at least.
Oh, yeah. I definitely don't
harm.
want it not to happen. I mean, I think it's necessary. But I'm concerned that it's really not going to be sufficient. Okay. That marketing, unfortunately, is going to be part of the story.
Thank you.
Thank you. There's one over there. Sorry.
Michał Polasik, Nicholas Copernicus University. I feel inspired by Keynote, and the question is follow it, because we discuss a lot about the new technology in context of trust and privacy. So the CBDC can be somehow a response for it, but it also put a question mark to existing system and banking system. It is not consistent, in fact. So, and as I analyze research on the implementation of GDPR or open banking, and now we have regulation on Artificial Intelligence Act, and if you work with banks, they really want to follow it, and they respect the area of usage of data, purposes, and so on. So maybe it's more efficient to regulate well and put outside, for example, European companies, big techs, to respect this law, than to provide another technology to compete with it in this area. So build more trust in consistent way in the existing banking system. What do you think?
It's a fair point. That there are various ways of generating trust, and it may be more easy to get it by taking known institutions and increasing the trustworthiness of them than to have the untested ones. But so the argument is going to be not over where you want to get to trust. It's going to be where you want to have what it is you think that these new systems can do that the old systems couldn't do, and then that's got to be the primary question. If that's big enough, then it's worthwhile instilling the new kinds of trust. And if it's not that big, then yeah, put your efforts on trust into the old institutions as well. I think that's the answer. I think that's the suggestion you're making, and I think it makes sense.
Any other takers?
The idea of trusting big tech because we could control them, and the EU, I mean, I don't know, the US governments haven't done very well.
No.
I can see all the big tech.
No, he's being optimistic. I'm assuming that,
Okay.
that we're talking about a regulatory system that works.
Okay, but in the US you haven't managed to regulate big tech.
No.
Europe is working very hard and has been for several years. UK, we haven't got a standing chance. We're waiting for everybody else. I mean, no, is my answer to that. No. For money, no. And that's what we're talking about with payments. I think money has to be sovereign. I think saved money is different, but money as the national asset and moving it, that has to be sovereign, in my view. The control over it. Now, we can talk about whether it's MasterCard and Visa and Barclays or Deutsche Bank. It doesn't matter. But there has to be sovereign rules over that. Otherwise, all bets are off, I think.
Thank you. Two more.
Hello. So I can understand the following. If you have a digital system only, a digital payment system only, then it's easy to regulate the bodies from the user perspective, as we've said, with money laundering or other deviant behaviors from the society. On the other hand, if you have the system, then either you need to explicitly trust the people who are handling it to not become the bodies themselves and exploit all this information for other applications. Now, I believe that I'm a dreamer myself, but I cannot see a future or imagine a future where we don't have a level of cash at a global scale, let's say. Okay, so what I'm looking for here is a little bit of intuition and maybe inspiration. So I want to ask two things. The first of all is like, looking into the future, do you believe that we will, as humanity or society or whatever, come to a point where we will have only a digital-only platform for transactions and payments? Yes or no, and if you can give some intuition as well. And at the same time, if we do achieve this, what would be the holy grail in the sense of properties or safeguards that both the regulators and the users will have? I hope that was not too long. Thank you.
The perfect final question. I confess I bribed you to up and mimic the moderator. Thank you. Please let a final round of answers, maybe starting with you.
No, don't start.
Okay,
what will the world of payments look like in 100 years? Lord, I don't know. Can I imagine a system where eventually everything goes digital? Yeah, I can't imagine it not, but a long, long time from now. So, and what are the safeguards going to be in that system? You're going to have to answer that part of the question. I have no idea. I mean, yeah, will it be as chaotic as it is now? Yeah, I'm afraid it will be, whatever it is. The technologies for the physical transmission will eventually go away, but it's going to be really slow. It's not going to be in my lifetime. It's not going to be in your lifetime either. So,
how should it be governed?
How it should be governed? It's going to be the same mechanisms we've got right now. I mean, in that respect, unsatisfactory ones and partial ones and ones that are in conflict because the different because there won't be a world government, so there'll be a bunch of different conflicting governments with different standards about how it should happen. And there will be the off-ramps as well, and the electronic versions of stockholders to adjust for the whether this particular payment system is working or not. So that part won't change at all in this story. The only thing that the physical stuff will go away in the process. Yeah. Now, how's that for a non-answer?
Thank you. Perfect.
I mean, will the physical stuff completely disappear? I don't know. I think there'll always be some kind of token that will move around. I mean, is it easier for us, and we can ask any Ukrainians in the mix, is it easier to leave a country with notes or with gold? And I think the answer is gold, because the gold is more exchangeable than the notes. It's a bit more cumbersome to move the gold, but out of choice, that's probably what you'd be doing rather than sustaining the notes system. I do think there was a lot of mention earlier about bureaucracy and vested interests. And I think when we think of the future, we need to remember the vested interests and the bureaucracy and the install base and the stickiness and the jobs and all of those things which, hopefully not over a 100-year period, but definitely over a shorter period, that can stop so much happening, for better or worse. Yeah. I mean, sometimes it is for better, but most often it's an anti-progress, and it works, frankly.
I don't know how to answer this question, but I think something that helps me sometimes is to remember things like, sometimes it's really hard to imagine the world changing, but when we look back in history, we see that actually there's quite regular dramatic change. It might be every 100 years or 200 years or 1,000 years, but it does happen. And so I think it's helpful to think about questions like, this whole central banking paradigm has actually not been around that long. There's no reason to believe it's going to go for the next 1,000 years. What's the next model? What comes after central banks?
That's very brave.
I know. Trying to be provocative.
Discussion stops here. I'm going to ask you outside.
Similarly, maybe this will be less provocative to this room, but the world's sort of reserve currency changes every few hundred years.
Yeah. That's more popular. Yeah.
What comes after the dollar? Yeah. Right?
You know the answer, yes.
That one less uncomfortable laughing. Okay, I see. Yeah. So I think to answer your question a little bit more directly, I don't know what things are going to look like in the future, but it's pretty clear that if we start looking at timescales like 50 or 100 years, things will dramatically change. They will. That's pretty much a given and a constant. So something that seems completely unimaginable now, totally possible, depending on how things go. What I'm most worried about, I guess, is that we bifurcate into this world where pretty much everything is digital for a certain part of society, and then there are other parts of the world or parts of societies which cannot operate effectively in that digital world because they don't have the right ID or they don't have the right device or they had some black mark on their record, when they were a kid or something like that. And there's this underground world because humans will invent money. Even if central banks don't give it to them, humans will invent money. And there will be a means of commerce and there will be a market because people have to survive. And so I guess what I worry about is this bifurcation. And remembering that we need to think about the release valve outside the system that we've designed so perfectly and remember that there always needs to be that kind of a release valve for people. So, yeah.
Thank you. We talked about the end of central banking. So I think we have reached the end of this panel. Preparing for retirement, and you prepare for refreshments, which are still outside served from the still living central bank. Thank you.
That was really fun.
Thank you, that was fun.
All right.
Thank you very much. First of all, I would like to thank the organizing committee for organizing this great conference and for inviting me to give a presentation about my paper. And of course, I would also like to thank very much the Austrian Central Bank for being such an excellent host. I really enjoy this conference very much. Thank you. Now, the paper, they told me I had 20 minutes, so I have to be quick. The use of financial apps is joint work with my colleague Hans Brits from the Supervision Strategy Department, and from myself. I work at the Payments Department of the Dutch Central Bank. It's about financial apps in the usage by consumers. This is a short outline of the presentation. I'm going to talk about a metric that you can use to measure whether the app usage is paradoxical or is rational. And I'm also going to use results from the discrete choice analysis to dive a little bit deeper into the drivers of the usage of financial apps. The background of this presentation, well, we all know that data has become a very important production factor in the economy. And also regulators try to make financial data available for other parties than the data holders in order to allow them to develop new services and to increase competition and innovation in the financial market. In Europe, the European Commission has come up with a revised Payment Service Directive a few years ago, which allowed account holders to share their information on their payments account with licensed third parties that can provide them with new services based on the payment data. Right now, the European Commission is also working on a proposal for a regulation on financial data access, which will facilitate customers of financial institutions to share also other personal financial data with third parties to provide them also with new kind of services. So this will imply that people may also share their information from the pension funds, the insurance companies, for instance, and about the wealth management with third parties. Well, what we realized in the time of the PSD2 coming into action is that, well, at that time, people were already quite active online, and we saw that many people were already sharing quite a lot of information on social platforms and in social media. And well, we had the impression that well, the usage of financial apps that may indeed lead to innovation and more competition, but it might also increase privacy risks, because in this payment account contains a lot of information, not only about your bank account number and your balance, but also about all your incoming and outgoing transactions. So if the data if something goes wrong with these data, people may know a lot about these people, about and also very sensitive information, like through memberships, fees, they may learn what kind of interests people have, what kind of political parties they favor, what kind of religious interests they have, and all that kind of thing. So, well, we were a little bit worried about the privacy risk, but also about potential increases in fraud, because these payment accounts, the data, they're also linked to the payment account itself. And there was also another innovation that third parties could also initiate payments on behalf of the consumer. So we were a little bit worried, on the one hand, because we knew that people are, well, they care a lot about their privacy, and they also have privacy concerns. But on the other hand, in specific situations, they are also easily enticed to give third parties access to their data if they think it may be beneficial for them. So that's actually what we're going to talk about, is the privacy paradox. And, well, to give a clearer definition of it, in the literature, it is often referred as a sort of an apparent dichotomy between people's privacy attitudes and privacy intentions on the one hand, and what they're actually doing on the other hand. And there are also quite a lot of issues with that privacy paradox. And one of them is that people express their privacy concerns and they have specific privacy attitudes, but they usually refer to very general situations. And if you look at what they're doing in as you look at their actual behavior, then that's always happening in a very specific context, in a specific time, with a specific company or organization, and for a specific purpose. So you are comparing two different things. On one hand, what they think in general, and on the other hand, what they're doing in a specific situation. So that may also explain to some part the gap between what they want to do, what they say they're doing, and what they're really doing. Another issue is, well, we want to look whether their behavior is paradoxical or rational. And then you have to think, well, how can I measure, how can I characterize their behavior? And it involves actually that you should try to find out whether they are making a sort of trade-off between the benefits of data sharing against the risks of privacy loss if something goes wrong with the data. And you also have to think, well, what do we mean with irrational behavior? Does it include that people only focus on the benefits and not on the risks? Or whether it also involves inaccurate assessments of these risks? Or whether it has to do with the timing of the benefits and the risks? So there are all kinds of issues around there, which are very interesting. Now we're going more to the focus of the research questions of this paper. What we try to answer are actually three things. First of all, we are very interested in knowing to what extent the Dutch households are actually already using financial apps that require the sharing of their personal financial data with third parties other than the provider of the bank account. We also want to know to what extent the usage of these financial apps by the Dutch can be described as privacy paradoxical or as rational. And the third thing we would like to know is we want to know more about which factors are driving people's usage of these apps that give third parties access to their financial data. Well, we have a few contributions to the literature. As far as we know, we are among the first that look at actual behavior by a large representative sample of consumers. We are also among the first that try to quantitatively assess the extent of the paradoxical usage of the data sharing apps. And we use a methodology developed by Gimpel in 2018 called the privacy paradox metric. And we relate it with people's general privacy concerns. And furthermore, we also we use discrete choice regression analysis to explain in more detail where the differences in general privacy concerns between people, the perceived benefits of app usage, the perceived privacy risks associated with app usage, and trust in app providers influence people's usage of financial apps in real life. And by doing so, we contribute to several schools of thought in the theoretical literature that try to explain the gap between people's privacy concerns on one hand and their actual data disclosure behavior on the other hand. We use a very rich data set. We developed a survey ourselves, and we distributed it to the members of the DNB Household Survey Center Panel. That's a representative group of Dutch consumers, aged 16 years and over. The survey was completed by almost 2,400 panel members, and they were, the questionnaire was distributed to them at the end of 2022. The survey included lots of questions, questions on people's general privacy concerns, following Weston's methodology in 1991. We asked them about the actual usage of three types of data sharing apps: the financial information apps, which were launched actually because of PSD2, mobile payment apps that people can use to make payments online, and also for comparison reasons, we also asked people about the usage of the activity tracking apps. Furthermore, we asked them about the perceived benefits of using these kind of apps per app type. And we asked them about the perceived risks of sharing their personal data. And we asked actually two things. We asked them about the severity of the impact if something would go wrong with the data sharing on their privacy. And we asked them to give a sort of assessment of the likelihood that they think they could become victim of a data incident in the upcoming 12 months if they use their app, or if they would use an app if they don't use it right now. And last but not least, we also asked them about the privacy sensitivity of a range of information items. And we looked at the different types of apps, and we could see what kind of data items the app providers are collecting. And by combining the information about what kind of information they are collecting and the privacy sensitivity according to the respondents, then we also get an information about how privacy sensitive they feel the data are being shared with these app providers. So there's a lot of information we try to get hold of. Here you see an example of the type of apps we asked for. So we give the respondents a description of the type of apps we are looking for. And we asked them which apps are you using. And in order to increase the recognizability, we also show the logos of these apps. And they could indicate which apps they used. They could also indicate that they don't use such an app. Or they could indicate that they used a similar app that was not on the list. And that resulted in a few additional apps in our survey. The financial information apps, they use the kind of services they provide to the consumers usually have to do with providing them with information about where they spend their money on. An interesting feature is that if you use these apps, then they can combine information from several payment accounts from different banks so that you get a nice overview of all your payments. Another thing that may be interesting for the user is that some of these apps, they help you save money because they can give you advice how they can save money for specific items. For instance, the provider of Dime, he looks also at what kind of energy contract you have, and he can give you advice. Well, it may be better for you to go to another energy supply, which is cheaper for you. And so they provide a very variety of services. There are also mobile payment apps. We focus on the apps that are provided not by the bank of the respondent, but by other parties, so that people have to share data with another party than their own bank. And with respect to the activity tracking apps, well, these are of course not non-banks. And we looked at the most popular apps in the Netherlands, looking at different magazines for running and health and so on. And we also asked several colleagues what kind of apps they were using. And also the Google Play Store and the Apple Play Store were also very helpful finding all these kind of apps. So that's how we got all these apps. Another thing that is good to know is that we focus on apps that are free to use, because there the privacy risks are most important. For the other, there's also apps where you have to pay for, but then the privacy risk may be lower. Well, then we're going to talk about how we measure the general privacy concerns of people. We used 3 statements that have been developed by Westin, and they asked people to what extent they agree with these 3 statements, whether they feel that citizens have lost all control over how personal information about them is collected and used by companies, whether they think that most companies handle the personal information they collect about consumers in a proper and confidential way, and whether existing laws and organizational practices provide a reasonable level of protection for consumer privacy today. And what's interesting, this questionnaire is already from 1991, so it's actually before the internet hype and before people already start sharing information online. So already before the whole that online environment became so important, people were already quite concerned about what companies were doing with their data. Marketing was already becoming important in the 1990s. So, in that respect, it's something that I realized a few weeks ago. Well, it's 1999, that's quite some time ago, but it's still very actual, actually. Well, the results. Westin divided the consumers in 3 segments. The privacy fundamentalists, privacy unconcerned people, and privacy pragmatists. The privacy fundamentalists, they agreed on the first statement and disagreed on the latter 2 statements. And we also included respondents in this group that answered neutral on at least one, on at most one of the statements. With respect to the privacy unconcerned people, well, that's exactly the opposite. They disagreed with statement 1, agreed with statement 2 or 3, and they answered the neutral on at most one of the statements. And the privacy pragmatists are the rest. And actually, what the privacy fundamentalists, they consider privacy very important. And they do not believe that their personal data are in safe hands when they share it with third parties. If you look at the privacy unconcerned people, they are actually hardly concerned about their data privacy. And that's why they also don't have a problem with sharing their data. And if you look at the privacy pragmatists, well, these people, to some extent, they have some privacy concerns, but on the other hand, they also have enough confidence that overall companies will handle their data properly and confidentially. If you look at the data in our sample, we see that about 30% of our respondents are privacy fundamentalists, 8% are privacy unconcerned people, and 62% are privacy pragmatists. And these figures, they are well in line with the results presented earlier by Westin among US citizens. Now we're going to the first research question. How many people are actually using the data sharing apps? And with respect to the financial information app, well, it was a little bit disappointing, actually. Only 4% of our respondents are actually already using a financial information app. There are relatively slightly more privacy fundamentalists that are using that kind of app, which was also slightly surprising to us. But with respect to the other 2 apps, we see that, well, the most popular app are the activity tracking apps, and the mobile payment apps are also used by many people. And we also see, as expected, that privacy fundamentalists make less use of these apps than the privacy pragmatists, and the privacy unconcerned people make most use of these apps. Now, the privacy, this is a bit difficult, slightly difficult part. Here we are going to try to characterize people's behavior. 2 minutes? Yeah. Now maybe I move on a little bit with the results. If you look at the behavior of people, we try to figure out whether they have paradoxical behavior or rational behavior. And the figures in red are referring to paradoxical behavior. And the figures in yellow-orange are also paradoxical behavior, but for the non-users. And what we are actually seeing is that paradoxical behavior by the users of apps is actually quite low, about between the range of 7 to 9%. And rational usage is actually quite high. These are the figures in green. What we also see that among the non-users, paradoxical behavior is higher than among the users, especially for the financial information app. I shall also skip here a few slides and move on to the probit regressions, in which we try to explain the drivers of app usage. And we have information from financial information apps, mobile payment apps, and activity tracking apps. And what we see is that in the columns 2, you see the impact of the consumer segment, where the privacy concerns of these people. And then we see that people, that privacy fundamentalists make least use of these apps, but we already saw in the summary statistics. But what we also see here in columns 3 and 4 is that perceived benefits correlate significantly and positively with app usage, and that also the privacy sensitivity of the data and the likelihood of becoming victim, of the assessed likelihood of becoming victim of a data incident, they have a negative impact on app usage. So what we actually are seeing is that people are really balancing the benefits and the downsides of data sharing. What we also see in the 4th column is that trust has a large impact. So if people have trust in an app provider, they're more likely to start using the app. But, and that's very interesting, if we look at the different, if we do run regressions for different types of people, then we see that there are a few things they have in common. So they both look at, they both look at benefits. They both look at the likelihood of becoming victim of a data incident, but they don't all look at trust in the app provider. The privacy practice people, they look at trust, how much trust they have in the app provider, but the privacy unconcerned people, they don't. So it seems, I'm already jumping to the conclusions, it actually seems that these people, they differ in the way they make decisions. They differ in what kind of information they use to make decisions. And that may, to some extent, it might explain maybe why they are differ in how, in their usage of these apps. Thank you.
Thank you, Nico. Discussion is Kim Hyun from Bank of Canada.
Can everyone hear me? Okay, that's great. I always want to play with this dais. Yeah, so thanks a lot for giving me this opportunity to discuss this paper. I learned quite a bit, and it's been great because before this Economics of Payments, I was at Advances in Financial Technologies, and discussing with the technologists, I also learned some things about privacy too. So truth be told, I did use a large language model to help me. It was, it's kind of time constrained. So anything I say is my views and my views only, and I won't blame the LLM or any hallucinations from it. Okay. So I asked actually Microsoft Copilot to summarize the paper for me. And that's the summary. So you have one view about privacy paradox. People say they care about privacy, but they're more than happy to give up their information. That's the left-hand side. The right-hand side is this privacy calculus. People are trading benefits as risks in providing access to their app. And it's a very nice study, very meticulous, like all papers I've read Nicole over the years. So the one conclusion is the privacy calculus gets us a check mark. So they find evidence that people aren't weighing off the risks. So I thought, instead of summarizing the paper, what I thought I would give you my thoughts on the paper. And the way I'm going to think about this paper is I'm going to focus on the extensive margin. The paper was focusing on the extensive margin of this decision to share data from the app with the app provider. But I just want to think about what is the amount and value of the data being shared, the intensive margin. So these kind of comments, and I show you some evidence of this. And then I always think about privacy calculus. I don't know if everyone here took calculus, most likely. We always want to do, before we do any calculus, we want to make sure those, especially those derivatives exist. I'll just give you some, what I'm thinking, what does that mean? I'll bring some case studies, and then from other jurisdictions. And then one of the coolest tricks I learned as a calculus student was You take derivatives, but you want to recover those derivatives, you do integration. And integration by parts. You take all these other studies, and hopefully it will get back that derivative, or that function that they've taken. So, of course, there's always a constant term floating around. Okay, so, and then the final thing is, now fast forward, when you go to grad school, we learn about contraction mapping, doing dynamic programming. And so why do I talk about this? Because one of the things that this study does is looks at this privacy calculus really in what we call the cross-section. But I think that the data that exists, more can be done. And I'll give some other examples of this. So hopefully everyone's okay. If my calculus is wrong, just raise your hand. I'll be very embarrassed. Right? We know that University of Vienna, which is very close, that's where the school of the marginal analysis, Colin Menger and Eugene van Barwick, right? So, okay, with that, let's go. So what's the value of privacy? Well, the Financial Times says it's roughly about 50 cents. They even made an app, web page, and then you can go there and you can put in some characteristics and they would tell you how much your privacy is worth, your personal data. Then I looked at this company called invisibly.com. They run surveys and they also do some marketing. So they found, well, this is roughly the menu of how much data is valuable. So the most valuable one is the healthcare record, right? So $250, all the way down to like the basic P2. Okay, so you can see where people really care about what type of data they have. Right? And as an economist, I always believe in markets too. So the other one is, well, that's what Invisibly priced it. Now they went and looked at the dark web, right, where all that exists, and then they got a menu of options. What would you like to buy today? I would like to buy a Canada-hacked credit card details with my CVV. I'm going to have to pay $28 for that. So there you go. What's the most expensive item on this list? It's a verified Stripe account with a payment gateway, which is $1,000. Okay, so there's some contrast in these payments, the cost of these, the value of the privacy. So I was always thinking about this. Going back to your study, all these apps have different value, right? So the activity tracker has this healthcare record that may be valuable to some people. The mobile app, payments, well, there's some value there too. And then there's the financial information. I always found that very interesting because in the study, only about 4% consented to share their financial information app. And we'll go back to that observation later. So that goes by first comment. Does the derivative exist? Well, here's an example of trying to find that if the derivative exists. So it was a very nice study by Decal et al. Apologies if any of those co-authors are in the audience. Sorry to put you in at all. They did a study to elicit value of privacy accuracy trade-off. And what they did was an experiment where they said, well, we shipped you, there's a firm and there's a customer. They shipped you an item, and they know some of those items are they're defective, so they give people the option to report that if you just run this diagnostic, you can tell if the item is defective or not. And then people, or the customer has to decide whether to disclose this information. Okay, so then they go into the laboratory to do these type of experiments, and they can find that on the x-axis is this epsilon, or this what is called the level of differential privacy. So when it's infinite, people know everything about it. And then on the y-axis is the average share of the contribution, like how many of these people are contributing to this. So you can see that roughly this function has this kind of step, and then it basically plateaus at 47%. So I always think that that's kind of something would be useful for us to think about in this privacy. There was a lot of this discussion at the on the dais here in the panel. right? So what is this privacy accuracy trade-off and that we're willing to trade off? Okay, so with that, I think that's one thing that, Nicole, you can do in your model is you have these two indices, the Western Index and then the Gimpo Index. And then at some point you did some cross-cuts of the data. But one thing you can do is you can always interact these binary variables, right? So once again, some calculus, okay? I don't teach calculus, by the way, so I'm not shilling for the calculus community, but I think it's very useful. So you know that once you interact those dummy variables, then you can create interaction effects. And you can compute the marginal effects rather than just having those point marginal effects. So I think it's very useful if you took that exercise, and I think we can learn quite a bit from that contour that you can draw. Okay, so now we go to the, thank you, the next part where economists meet a philosopher and a computer scientist sometimes. Reina, I know you don't believe this, but so Charlie covers this in his keynote, so I'm not going to belabor the point, right? But this is how economists think about privacy, right? These three items. And this is how the philosopher and some computer scientists about this idea of contextual integrity. And some of the discussions that were at the panel was about this, right? How is privacy defined? It's 5 parameters. What's the data subject? Who's the sender of the data? Who's the recipient of the data? What information type you have? And the transmission principle. So I think these things are really important because we have to understand what's the context of this. And that's what I would try to do. And I tried to rack Charlie's mind to see if we can combine these things and see how we can test this potentially. So there's a very nice study by Raphael and Reina on mapping privacy landscape for central bank digital currencies. And they did that. They looked at 3 stakeholders: law enforcement, privacy enthusiasts, data holders, right? And then the type of payment method: cash, payment network, cryptocurrency, soft privacy, CBDC, hard privacy, CBDC. And you can see the assessments they would have for each party, right? From law enforcement to the privacy enthusiasts to law enforcement, privacy enthusiasts to data holders, and so on. So the paper's online. You can read it. I think it's great. It's a short paper. So, okay, so going into the type of apps. So I always think from a survey methodology point of view. So the authors, they put what type of apps, but they also gave an option to people to fill in apps. That's very important. So when people fill in some app, don't use that information. And so for example, for the mobile payment app, there's Afterpay and Riverty, and then for the activity apps, there's Runkeeper. So you probably don't know what they are. So Riverty is Afterpay is a buy now, pay later, and actually there's cases right now in the Netherlands where there's advocacy to add even more data that needs to be shared in order to use this. So this becomes a privacy breach. Runkeeper, right? It's an activity app. The Norwegians really disliked it, and I think Wilco, you mentioned about Norway. But Norway is a country where everyone gets to see everyone else's salary. Okay? And so if you want, on that tax day, everyone floods the servers to look at what the data is. Okay, I have like a minute left. Integration by parts. So Nicole, you did this on the cross-section. So we have a new RA. The best way to retrain our RAs is to actually do some research. So we did this. We re-rest cash on hand, right? Cash is deemed to be private. And then to see if the person respondents had any identity theft. And you can see it's always very significant, okay? So that part is in the cross-section. Here is what I'd like to do, the other part is look at the dynamics. Suppose you had a privacy breach, identity theft. What would be the effect on your behavior? And so this is from the Philadelphia Fed. It's a very nice study. So you can see that after a breach, people, they get kind of aware about things, but it's very negative and small and transitory. But after that, the victims actually get used to doing these things, and they actually learn and do and improve their credit scores. So I think this dynamic part would be useful. And this is where it goes back into this, the contraction mapping. So this very nice paper, Nicole, they mentioned this about data privacy and digital demand. You should read it. It's great. They do a survey, but then they also, in China, about apps, if they're concerned about their privacy. And then what happens if there's a compromise? What do people do? Leading up to that event, people canceled it, but then after that, it just dissipates. So once again, beware of companies providing QR codes to you. Thank you.
Thank you, Kim. Nice discussion. So before opening up, Nicole, you want to respond to Kim's discussion?
Discussion. Also, I like your pictures. I also tried to use Copilot for making pictures, but the mine were less successful, so they didn't make it to the presentation. So I would really like to see your prompts.
Happy to do it.
I also like the suggestions you made about other information that I could use in the paper. Indeed, the definition of privacy is very complicated. Right now, I'm busy in the revision of the paper, and I'm also diving in all the privacy literature, and it's a very rich literature. And indeed, in the revised paper, we pay much more attention about what kind of privacy we're actually talking about. But to the respondents in the survey, it was quite clear what kind of privacy we actually meant. It was all about the privacy of the data we were talking about. And we also gave them quite a list of data breaches that could happen. There's different types of data breaches, so that they could reflect on how severe they would find something, if something would happen like that to them. And we also asked them, how likely do you think it will be that something like that could happen to you? So we really try to channel their responses in a specific way. Furthermore, about interaction, the Westin group with the PPM metric. Well, we actually wanted to have, in our regressions, we wanted to know, I had the impression if I interact the Westin dummies with other variables, that would be less flexible than if I would run separate regressions per group. So that was actually the reason why I ran separate regressions per group, so that I could see for each driver what would happen if I would only look at the impact of that driver in that specific group. Because we had quite a lot of drivers in it, and if I would use too much interactions, it would become a little bit of a mess. And also, with respect to the people who are privacy unconcerned, there weren't many people that had that, who are in that segment and who are using apps. So I was also a little bit afraid of estimation problems. But I will take a look at your suggestion. Thank you. And I will also look at Dakel's paper. That sounds very interesting. I didn't have that in mind. Thank you.
Thank you. Maybe two questions.
Yes, thank you very much. It's a very interesting paper. Just one observation. As far as I understand, the way that likelihood of data breach was measured was basically it was the subjective assessment of the respondents that was measured. And it's a comment. I think it because the whole conclusions from the paper are that people rationally give away their data. But to what extent have you tried to verify whether the subjective assessment of the likelihood of data breach was in any way realistic? Because I mean, for the severity, okay, I understand that was there. I can accept better the subjective assessment of severity. The subjective assessment of likelihood is more difficult, especially if we want to use the results for any, let's say, policy related work. Thank you.
Well, I think you raise a very important point here, because I was also struggling, because there was also a picture I didn't show with where I showed the privacy risks by Western segment, and then you see that the people who are the privacy fundamentalists, they perceive privacy risk higher than the other groups of people. And then you start thinking about who is right? Is it that the privacy fundamentalists are too pessimistic, or are the privacy unconcerned people too optimistic about the probabilities that they could become victim of something like that? And the problem is that we don't have reliable statistics yet about the incidence of fraud. So I think it would be very good for all the people, also the privacy fundamentalists and the privacy unconcerned people and the privacy pragmatists, to learn more about the likelihood of becoming victim of a data incident if you make use of data sharing apps. Because that will help them in their assessments and the trade-off of, do I think that the risk of becoming victim weighs against the benefits of using such an app. And the same holds, I think, for the severity of an incident. Because, well, the very funny thing actually is, if you look at the estimations, you actually see an insignificant or sometimes a positive significant impact on app usage. So I also try to find out where that's coming from. It's some things people seem to like. People seem to like that data are being used to give them more advertisements. And I thought, well, I wouldn't like that, but probably they do. They also don't mind that their information is used for price discrimination. So I think, well, maybe they don't really understand what that means. But so other incidents are clearer to them. But there was not really a clear relationship between the severity of a data incident and the usage of the app. So I think it would be very good if the regulators and also other public authorities would spend more attention to collecting information about fraud with data sharing apps, and also informing people about the results. Because they should know on the one hand, they should learn about the benefits of these data sharing apps, because it's also very funny that people don't use financial information apps, although they think it may be beneficial for them. So it's also a bit funny. But on the other hand, they should also be informed very well about the risks associated with it, especially because the European Commission is promoting the launch of such apps, and they are promoting data sharing. So they should also help people to make well-informed choices.
Thank you. Very shortly, how should I interpret the results of the paper? So are people rational after all as it regards privacy? And if so, isn't that very surprising given what we know from behavioral finance and the biases that we all have?
Oh, I have the results show that overall the users are rational. Most of the non-users are also rational. So I think with respect to data sharing apps, most people make a rational choice, and there are not many people making an irrational choice. And I think the difference with other type of situations may be that the benefits, maybe it takes a little bit more time before they get the benefits of these apps. For instance, if you do an activity tracking app, well, you have to start installing that app, then you have to start running, and then after you run, then you only see the information, your benefit. Whereas if you are browsing on the internet and you want to have some information from a website, then you have to click on a few cookies. then your benefits is really immediate. But with these data sharing apps, the benefits, well, they come quicker than the privacy risks, but they do take some time. And especially with financial information apps, well, people also do not find it very entertaining to use these apps. So maybe that also helps people making more rational decisions. Does that answer your question? Yeah, the drink.
Okay, with that, let's move on to the second paper. Thank you, Nicole. Thank you, Kim. So the second paper is fraud across borders, presented by I don't think I can pronounce it. Davish. Laval at Federal Trade Commission.
Thank you all for coming here, and thanks for the organizers for inviting me. I'm trying to Bjorn. It's this paper to be about the economics of payments on the advice of Kim. So any comments that you have would be very much appreciated. So this is joint with Michel Gross, who's my colleague, but he just had twins, so his hands full, so he couldn't make it here. The obligatory disclaimer applies. These are my opinions, not the opinions of the FTC or its commissioners. So I want to start for the first 5 minutes with just some background. So cross-border fraud has become an increasing problem. So this is statistics from our consortium of complaints, which is called Consumer Sentinel. So in 2023, we received 330,000 cross-border fraud complaints. So that's where the customer or the consumer is located in a different country than the company, which is about 13% of the total. If you look at the losses that consumers reported just in 2023, there was $1.5 billion. So it's a lot. And we know that this is just the tip of the iceberg. So there's a lot of research, both by me and by others at the FTC, that very few people complain after they experience fraud. And so we think that maybe 300,000 cross-border complaints and $1.5 billion seems like a lot, but it's probably an order of magnitude larger. And I want to show you a little bit. So this is from the FTC's Tableau page, both of where this is coming from and how payments are happening, given this is a payments conference. So we asked people, how they were contacted. If you look at cross-border complaints, most of them are coming online, either recruited from social media, so the fraud comes from social media, or for other websites and apps. And then the next, I guess, is email. So a lot of this is coming from stuff going on online. If you look at how payments happen, the biggest category by far is wire transfers, about 50%. The next is credit cards. I guess cryptocurrencies, you can't see here, is about 10%. This is a bit misleading because we're getting complaints now from wire transfer firms like Western Union and MoneyGram, but I think this does help to just show you what kind of payment networks are being used. Now, I would say there are three things that we've tried to do with the FTC to remedy this. So the first is try to encourage complaints. So this is a website called econsumer.gov, and it's trying to get international complaints. So you can complain in German, French, I think Korean, Turkish, and so on, to try to get people from all around the world to complain about cross-border issues. And you can see here it says report international scams online. So it's oriented to international things. So that's the first, is to try to get complaints to find out what's going on. The second is to try to have more cooperation between regulators across countries. So in 2006, Congress passed the US Safe Web Act. That made it easier for the FTC to share data with foreign regulators, made it easier for the FTC to help foreign investigations, and also do more international cooperation type events like MOUs and staff exchanges and so on. This is always at the danger of sunsetting, but we hope that Congress will re-up it when it comes due. But it's still very difficult to prosecute things that happen across borders. So for example, a couple weeks ago I emailed a lawyer and said, here's a lot of evidence that company X is committing fraud. And the lawyer's response was, as you know, it's very difficult to do something if the company is not located in the US. So I think a lot of the cross-border fraud we're seeing is this gap between where the consumer is and the regulator that's trying to protect them and where the company is. So another thing you could do is to try to crack down on the payment network, so the way that the money goes from the consumer across the border to the company. So what we've done in the past few years is sue major money transfer firms on the grounds that they've been doing insufficient efforts to combat international fraud. So for Western Union, we got about $600 million in settlements, along with a bunch of injunctive relief. For MoneyGram, it was about $125 million. So again, a lot of this is maybe we can stop this kind of cross-border fraud by stopping the money crossing borders. So this is basically a few minutes of background. What I'm going to do in this paper is to try to model cross-border fraud and try to see where it's coming from. So first, I'm going to develop a model of trade that includes fraud. That model is going to predict gravity in flows of fraud, which we're going to proxy with complaints. I'm going to show you evidence from 3 data sets that we do see that kind of gravity. Then I'll show you how we can use the model. So this is kind of a simple stylized model to generate a country-level fraud index, try to see where the fraud is coming from. And then lastly, I'll try to assess the determinants of where the fraud is coming from. So what's determining the country-level fraud rate? So here the model is a very simple stylized model. To my knowledge, I think this is the first model I've seen trying to explicitly model cross-border fraud in an economic framework. So we're going to use the Armington model of trade. So in the Armington model, each country has a variety, so each country is producing a good. Second, there is an iceberg cost of trade, so there's some cost to ship that's based off of distance. Now what's new here, so these two are basically what the Armington model looks like. What we're going to add is, first of all, each firm is sort of a representative firm. They can choose how much fraud to do. And then there's a regulator, which I guess is many of us in this room. It's going to be the regulator of where the company is located, and they can fine you if they catch the fraud. So if you put this model together, there are 2 things I want to show you. First of all, in this very simple stylized model, the fraud rate is just at the country level. So we don't see differences in fraud across where the consumers are located, just where the country is. So this is FI for where the country originates. It's not FIJ. We have a very simple closed form. So here, DI is the probability of detection. So we have less fraud if it's easier to detect fraud. And then second, CIL over CIH is the ratio of the cost of committing fraud, which is sort of the low-quality good, versus the cost of producing the high-quality good. And what the model predicts is that there's less fraud if it's more expensive to commit fraud, or rather if the cost of producing the high-quality good is less relative to the low-quality good. And at the very end, I'll try to test these 2 with the data. So next, what we're going to do in practice is use all the complaint data that we've been collecting. So to do that and take the model, I need to put in complaints. So the main assumption I'm going to put here is that the probability of complaining doesn't depend on where the fraudster is located. So if we do that, we're going to get a very simple form. So here CIJ is the complaints for company I, consumer J. So that's going to depend on 4 factors. So first is gravity. So there are going to be more complaints when there's less distance. That's because there's more economic activity between where the company is located and where the consumer is located when there's less distance. Second, there are going to be more complaints both when the country's GDP is larger and the consumer's GDP is larger. So that's sort of natural in a gravity type model. And then finally, complaints are going to be higher when there's more fraud by the firm. So if you look at the equation up there, tau ij is the distance, so that's the gravity factor in red. Then we've got essentially two fixed effects, one at the I company level, so where the company is located, and the second one at the J consumer level, the country where the consumer is located. Now what we're going to do in practice to generate a fraud rate is just take the difference between the origin fixed index for a complaint regression and a trade regression. So the idea is that we know there's certain factors like how big the country is, both of where the consumer is located and where the company is located, that's going to generate more economic activity. We also know that economic activity is going to be affected by distance. When you difference out the fixed effects between the trade regression and the complaint regression, we can get just the difference in fraud rate. So that's sort of the empirical way to get a, this is a very simple stylized model, but we can try to get at how much fraud we're getting more than we'd expect just from the spatial arrangement of economics. So we're going to have 3 data sources here. So I'll try to go over these in detail. So the first is the Consumer Sentinel Network. So this is the data I was showing you at the very beginning for several years. So this is a consortium run by the FTC. It's getting complaints from the FTC, other government agencies like the Consumer Financial Protection Bureau, non-governmental organizations like the BBB. For international complaints, there are 2 other sources that matter. First is as part of the lawsuits where we sued the money transfer firms. Some money transfer firms are now providing complaints into our database. And second, there are a couple of databases that are specifically about international or internet crime. So for example, the FBI has an internet crime complaint center. We're getting complaints from there too. Now one issue in the Consumer Sentinel database is that for most of these, the consumer has to know who's defrauding them. They need to put both where they live, but also where the company is, and they may not know that. So they may report somebody with a foreign accent called me and tried to scam me, but they don't know that they're located in India or the Philippines or wherever. So for the money transfer company, so this is an anonymous money transfer company, for 10 years, so we have their entire complaint database. And so there you can see both the sending agent and the receiving agent. And so we know exactly where the money went to. So we can at least see at the first stage of the supply chain of fraud of, when somebody told you, send money here, we know where it went. Now lastly, both of these databases are somewhat US focused. So complaints to the US, despite our efforts, are mostly from consumers in the US. So we also have data from the Australian Competition and Consumer Protection Commission. So this is getting a lot of complaints, mostly from either about Australian firms or Australian consumers. So in total, we have about 15 million complaints just from Sentinel alone, in which about almost 1 million are cross-border. The money transfer company has a lot fewer complaints, but a lot more of them are cross-border. Now the regression we're going to run is a flow, either of trade flows or complaints, between country I to country J on distance, and then source and destination fixed effects. So this is basically coming straight out of what the model says should be happening. For distance, we're going to use several measures. There's both physical distance, but here with fraud, I'm going to show you that cultural distance matters a lot too. And then we're going to estimate this using a Poisson model. Because there are a lot of zeros in the flows, so there are going to be many places, we may not get any complaints from Djibouti to Ukraine or something like that. So for physical distance, we find it matters in all of these. So for example, a 10% increase in distance is reducing trade flows by about 6%. For the money transfer firms, I have both. So first is Consumer Sentinel, where it's about a little bit smaller, 2 or 3%. For the money transfer firm, we can look at either complaints or dollar flows, but they look almost exactly the same, very similar as trade flows, as is the effect for the Australian Competition Commission. So physical distance matters. If you look at common language, so cultural distance, that matters a lot more for fraud relative to trade. So it matters for both, but it has much larger effects, for example, if you look at the money transfer firms relative to trade flows. Whereas conversely, if you think about contiguous borders, that matters for trade. It doesn't really matter for fraud. Now what we're going to do next, so I've showed you sort of what matters in terms of distance. Then we're going to get these source and destination fixed effects, and then try to compare the source country fixed effect between the trade flows and the complaints to get at this fraud index. So the idea here is we're asking, after you control for distance, what is the country's volume of complaints relative to their volume of trade? So I think it's helpful to give an example. So if you have Germany, they have about 1.6 here of complaints, but about 1.6 for trade. So essentially, they have about as many complaints as we'd expect, given their position in the, in the global economy. Whereas if you look at Benin, they have about the same number of complaints as Germany, but there's no trade coming from Benin. So this is going to be looking like a country with a high fraud rate. And then we're going to standardize this to mean 0, standard deviation 1, so everything can be interpreted in standard deviations. So these are the regional patterns for just broad regional places, weighted by population. So the most amount of fraud is coming from the Caribbean, then North America, and then Central America here. And then the least is coming from South America, the Middle East, and from you guys here in Europe. If you look at the map, you can sort of see there's some hotspots, one of which is the Caribbean, which is hard to see on the map. The other is West Africa. So Africa overall doesn't look so bad, but West Africa looks pretty bad, which is what you expect from the Nigerian scam and a lot of the news we see. If you look at just sort of doing this at the country level, the top countries are Jamaica, Benin, Gambia. There are also countries in civil war like Syria and so on. So here you can kind of essentially get a measure of how much fraud are we getting relative to what we'd expect. So this will be very different if you just look at what countries produce the most complaints, because then you're going to get big countries like China, India, coming to the top just because they're very large. If you look at the money transfer company, you get mostly similar findings. So again, Caribbean is really large. South America, Middle East are pretty low. The only difference is you see more complaints from Asia, both South Asia, so India, and East Asia. So here's the map here. So you can see Russia, China, India are much redder than in the previous one. So in the money transfer data, we're seeing a lot more stuff from Asia. But otherwise, the correlations are like 0.75, 0.8, I believe, between the two measures. Now, the last couple minutes, I'm going to talk about what's explaining the variation in the fraud rates. So the model had a very stark prediction. What would matter is both the probability of detection as well as essentially the comparative advantage in committing fraud. So we're going to proxy these by a governance index coming from some World Bank measures for the probability of enforcement, and then per capita GDP as the cost of fraud. So if you look at per capita GDP, we definitely find the richer countries have less fraud, which we might expect. If you look at the governance index, we also find that better governed countries have less fraud. Now, these are obviously correlated because rich countries tend to be better governed. If you put both in the regression, we find that what matters is per capita GDP. So essentially, poor countries are specializing in fraud relative to rich countries. So let me conclude. So first of all, what we find in this paper is that international complaints, so complaints about cross-border fraud, generate gravity just like trade does. You can use this model, the empirics, to try to find out where the hotspots are for cross-border fraud. So that's the Caribbean and West Africa in this data. And then finally, we can examine the determinants of cross-border fraud, and it seems like what matters is how rich you are. So since this is a payments conference, I want to end with what the future might look like. So this is maybe not 100 years out, like was asked in the panel, but this is reported. So this is from a blog post we put out, I guess, a couple weeks ago about reported fraud losses from Bitcoin ATMs. This has been going up a lot. And I sort of expect that as crypto becomes easier for consumers to use and maybe more available, we may see more cross-border fraud happening from crypto relative to, say, payment networks like Western Union and MoneyGram. So with that, I'll conclude. Thank you very much.
So the discussion is provided by Simonetta.
Thank you for inviting me to discuss the very interesting paper that was just presented. So I'm trying to see how to shift the slides, sorry. Usual disclaimer, whatever I say is not necessarily shared by the ECB. I would like to say, to start with, that I like this paper very much. So my remarks are mainly focusing on the importance of cross-border fraud within the broader context of payments, of cross-border payments, and giving suggestions on how to probably extend further the study subject to data availability. So first of all, cross-border fraud is something that really matters, especially in payments, we see that fraud is something that becomes increasingly complex, is difficult to detect and assess, and it has a lot of cost for society. In the European economic area, around 4 billion already in 2022. We have seen also in Europe that the adoption of certain measures like strong customer authentication have been very effective in reducing, for example, the card frauds. But this led now to a shift of fraudsters towards social engineering or more complex strategies compared to just hacking data from cards and using them. There is here also an element of distinguishing in the payments field between what is payment authentication and what is a payment authorization. Now, this distinction may seem a bit trivial. I will come back on this later because I think that this is an important point. And also there is an element of globalization of the fraud industry. That is, fraud is offered as a service by specialized criminals that operate on a global scale. So this is important because if the supply chain of this industry is spread across different jurisdictions in the world, this also has some relevance because you look at pairs of countries, pairs of, and where here we have a broader chain where the two countries where the payment starts and or the fraud starts and fraud victim is and fraudster is just part of the picture. There are other countries involved afterwards as funds are moved. Okay, so very short review of the paper. It was just presented. I don't need to say much, but basically the authors look at 3 fraud complaints databases. They estimate various specifications using a gravity model, propose an index to identify which are the so-called fraud countries, and predict the countries with high fraud rates, based on an index created using GDP measure and a public governance index. So what are the results? I'll just cover some selected findings. So, okay, first results just said, yes, there is gravity, and there is a strong negative link to geographical distance, but an even larger and positive role for a shared language. So this is even larger in the case of money transfer data. And distance has a stronger role for certain types of frauds compared to other types of frauds. Fraud countries, just shown, there are fraud hotspots. Fraud appears high in North America, Caribbean, West Africa, and to a less extent in Asian. And also in the paper, it explains there are hotspots in countries experiencing recently violent conflicts. And for money transfer data, there is a lower role for North America, but the main overall regional patterns still hold. What are the predictors? As expected, there is a negative relationship to a country's wealth and a positive one to governance. So countries that are more advanced and richer and have stronger governments, enforcement, and rules have a lower fraud. So, first element for reflection is the data sets. So these are self-reported complaints, and so you use fraud complaints as an indication of fraud, but this is slightly different from, let's say, post-investigation confirmed fraud. So there could be some false positives in case, for example, of dissatisfaction on the quality of a product received by a consumer who thinks that he has been, he received something not as expected, but also underreporting of some type of fraud, as you also mentioned, especially for financial frauds. This is a typical behavior due to victims' shame. and people not willing to admit that they were victims of this type of frauds, especially in case of these Nigerian prince scam or relationship scams that are really attached also to some emotions of the victims. So at least in the payments world, we make the difference between the concept of a fraud and a scam. So in case of a scam, the payments itself was executed by the legitimate party. Although the payment is part of an illegal activity, that is the fraud, an underlying fraud. Payments fraud is instead something that happens when fraudster has gained control to an account, to credentials, and this is really a legitimate payment. In the paper, I found the definitions of fraud a bit vague, so it might be useful to maybe explain this dimension, although I admit that this is something more relevant for the money transfer analysis. It was not very clear to me if the money transfer data on fraud were referring to the use of money transfer only in case of frauds, or also to the illegitimate transfers, for example, an hacking of an account, of a money transfer account. The paper is skewed towards North American consumers. There is an effort to broaden the data, so considering also Australian data, but this remains a bit in the Anglosphere, so maybe it could be useful, as the authors also mentioned, to look closer in the future into frauds patterns of other areas like China that have been identified also as, or other Asian countries. So for the hotspot regions, you could look at distinguishing more, to the extent that this is available in your data, between goods-related fraud, service-related fraud, and financial scams. And again, this distinction, if available from the data, between payment fraud and payment scams. And then, okay, in countries of conflict, here there can be some self-selection bias, because, of course, the emergency funds came, by definition, happen when there is an emergency, so either a conflict or a natural disaster or something like that. Then I was thinking, what about private governance? It is true that strong civil societies, organized interest, advocacy, consumer groups, and so on, are also typical of advanced economies, where there is also normally a good public governance. But still, I thought it could be interesting to at least reflect this dimension. And I was wondering whether there is a way to investigate how cultural elements of fraud shame may affect the underreporting in different countries or different areas of the world. Country pairs versus globalized fraud. Here what I meant, I already mentioned this, but what I meant more specifically is that with the supply chain, basically, there is a victim in one country, the first contact of the victim is in a second country, and this is probably what you observe from your consumer sentinel data. Then there are other countries involved in this, because fraudsters use platforms in a third country. They can use hackers who are based in a fourth country, and then in the end they can also receive the funds in another country and then move immediately the funds to yet another country. And in the money transfer data, because you see where the payment starts and the receiver country, you probably see different things, because after the money reaches the receiving country, probably the story continues with the funds being moved furthermore to in even more remote countries, difficult to reach by investigation agencies. So the future here, you mentioned cryptos. Cryptos is an important element, both as a payment means, but only it is considered a cyber threat enabler, because usually also in the area of cyber attacks, this is used as but there is another dimension, that is that cryptos is also associated more and more to investor scams, especially as newer generation try to invest in cryptos, allured by the gains of cryptos. This becomes an important investor scam vehicle. And then there is artificial intelligence-assisted cybercrime. This is a big development, and of course, artificial intelligence tools power the criminals. But on the positive side, there are also they also offer monitoring of abnormal payments patterns and fraud detection capabilities. So, in conclusion, I wanted to say one last thing, if you allow me, on instant payments, because when we speak about fraud in payments and the possibility to mitigate the impact of the fraud, recover the funds, is more and more decreasing with the spread of instant payments. Of course, there are measures there, including regulatory measures taken especially in Europe, for instance, with regulation to mitigate these, but of course with an instant payment, the time to recover the funds doesn't exist. Evaporates. So in conclusion, this is a very interesting paper, and there is a continued need to deepen this type of analysis, and I think also an initiative to share granular data is very welcome in this area, not only for investigative agencies, but also for researchers and the general public. Thank you.
Thank you, Simonetta. Really nice discussion. So, do you want to respond to?
Thank you very much for those comments. They were very helpful. I have a couple of quick responses. First, I think the fraud versus scams is quite important. It's not something we do, but I do have an additional database of identity theft victims, and there I think that is very much somebody stole their identity, and then so we may be able to use that to get at that versus the fraud data. Second, in terms of underreporting, I think that is a big problem. So we've done victim surveys, and we find maybe 2.5% to 5% of people complain to the government or the Better Business Bureaus, or those sorts of things. So we know there's a lot of underreporting. It's probably less for when you lose a lot of money than if you lose a little bit of money. But I think it is a concern with this. We don't know exactly how that relates to the international fraud dimension. And I agree with the supply chain point. Like, we may be only seeing the first leg of the supply chain, and there may be other legs of, we see a lot of stuff from Jamaica because it first gets to Jamaica and then gets wired to China or Russia or something some other way. But with that, I'll open it up.
Okay, this gentleman. Microphone is coming.
And if anyone has data on the non-Anglosphere, I'd be happy to include it in the study.
Yeah, you first.
You can go first if you like.
Okay,
you first.
Thanks. Kahn van der Kruijsen, Dutch Central Bank. So I learned a lot about who commits the fraud, but I'm also interested in your consumer data. Whether you, for example, know who are the people that fall victim, because from our study in the Netherlands, we know that a lot of people are not aware of all the different types of fraud. And for example, there's a difference between females and males in fraud knowledge. And I'm wondering whether your data is also rich that you can tell us something about who falls victim, and such that we can help those people to become more aware of the different types of fraud and change their behavior as well.
Yeah, that's a good question. In the main data set, we can see people's names, so we can look at gender. We can see where they live, like their address, and we can potentially see age, at least for complaints to the FTC. The only thing I've looked at is the country they're coming from, and it tends to be, as you said, from the Anglosphere. So we see the US, Canada, but also maybe Australia and all. And I think a lot of that is English-speaking people are the ones complaining on this.
So
So I appreciated when we talked about the false positives and the false negatives, because ultimately receiving a complaint is different. Instances of complaints are different from instances of fraud, right? There are complaints that are actually not fraud, and there are fraud that are not captured by complaints. And I'm interested to understand what you've done to look at, to actually look at biases among different jurisdictions that are in this, that have been covered by this study, not only because there might be some impacts upon these false positives and false negatives, but also because the biases might actually indicate an effect of the mechanisms that we use to mitigate fraud. For example, regulations, policies that lead to perhaps more or less detection of these behaviors, or even a choice to use fraud versus not as a way of transferring money or as a way of addressing some other kind of problem. In other words, are we really just pushing on a string when we try to mitigate fraud via the various methods that we've seen? Thanks.
Yeah, so I'll answer maybe some of that question. I think, all of the complaints here are unverified, so we don't see, we don't actually try to verify them. But I suspect the underreporting is a much bigger problem than false positives. There are crazy people that complain, but I think it's a small share. So in other work of mine, I've looked at some of these biases. So first of all, I have data sets where I could compare the complaints to victims in the same case. So first of all, there's an enormous amount of underreporting. But the main finding of that paper was that heavily minority areas in the US, either black or Hispanic, were a lot less likely to complain. And a lot of that, at least I related to social trust. If you're less likely to feel that kind of social trust, if you're alienated, you're less likely to complain. I could see that varying across countries as well. Second, I have another study where we look at a big change in the website to make it easier to use, and complaints went up by 30% overnight, and it was just people that were more likely to complete the complaint. And there we saw complaints that were shorter and easier to read, which I think is probably less sophisticated consumers, but it was also scams where people were less likely to lose money or report things about money, which may be, this is about a pro-social thing and not, trying to recover your losses. So as you make it easier, you get more of that. But I think a lot more could be done on that dimension.
I was just wondering a little bit about the costs of fraud and the costs of fraud prevention, or trying to avoid costs somehow. Somebody has to pay it, probably the consumers. And Simonetta was talking about strong consumer authentication, and the ECB, I believe, deemed it a success. But I think if you ask merchants from small, medium-sized enterprises, strong customer authentication is a hassle for to check credentials for every payment above 60 euro something. So in the end, the question is also a question of trade-off. How much fraud are you willing to sort of accept in trading off the cost to prevent it? Is that an issue?
So I'll give two responses. So first, if you look at our budget relative to how much money we recovered for consumers, I think we do have a pretty high return, which says that maybe you could give more money to the FTC. But the second is on the pushing on a string. So we've sued these money transfer firms, trying to push them to do more. So for example, with Western Union, there were a bunch of agents that were in fraud rings. But there probably will be some substitution from, say, Western Union to cryptocurrency or gift cards or things like that, that maybe it's harder to, with Bitcoin, maybe it's harder to find someone we can sue.
Any other questions? Without any questions, then, oh, okay. No, we can continue.
I have a very simple question. I'm wondering, how do the fraudsters get the money out of the system? How does it work with all the AML and so on? It needs to settle in an account, and then somebody needs to come there and get the money. Have you looked into that, how that happens?
Yes,
why this is possible?
It depends on the payment network, but I'll talk about money transfer firms. So like with Western Union, a lot of the allegations of the complaint, both Western Union and MoneyGram, were things like certain agents, say in Nigeria, were actually part of the scam. You know, there was a lot of, there's some way where they convince consumers on social media or something to send the money. Once it's sent through Western Union, you can't send it back. And internally, obviously all of these companies have some sort of red flags and other measures, but maybe they weren't enforcing it enough to stop the flows there. But you know, I think that question is going to depend a lot on who the firms are, how it's being done. You know, I mean, in previous work of mine with the telecom companies, again, like they have risk flag measures, they can look at refund rates, they know where the fraud is coming from, but there's a question of what the incentives are to do something about it, especially if you're making returns off of the transfers or making returns off of the funds. But I think that's going to be case specific.
Okay. All right. With that, let's finish the session.
Thank you so much.
Thank you very much.